Hello my dear CMA Inter aspirants. In this particular video, we will have a discussion on a model examination question paper which is applicable for you for those students who are actually pursuing their October 2021 attempt as well as the December 2021 attempt. So in this question paper is framed on the actual past exam questions, and we will have a detailed discussion over the theory questions, MCQ questions, one-word questions and other huge numerical questions with adequate explanations and working notes. So happy learning, friends. Let's get started. So we will start with the first question. Question number 1A, and this part is to choose the most appropriate alternatives from the following. So what you need to do after reading the question, you must select the correct option from the options given below. So we'll start with the first alternative, that is first question. In case of loss, a partnership firm may claim deduction in respect of remuneration to partners to the extent of. So the question is actually a direct and a simple question. Say a partnership firm is in loss. All right. And the question is under section 40B. Hope you remember there is a ceiling limit for the remuneration paid to partners which we can claim. All right. So a partnership firm, while paying remuneration to its partners, can claim that remuneration as a deduction subjected to certain ceiling limits under 40B. So this question is in relation to 40B. So what they are asking, if a partnership firm incurs loss, then what is the minimum amount of remuneration that they can pay to their working partners to claim it as a deduction? All right. So the first alternative given is rupees 1,50,000. Second alternative given rupees 1,50,000 or remuneration paid whichever is lower. Third alternative, rupees 1,50,000 or 90% of the book profit, whichever is lower. And option D, nil. So as you know, under 40B, there are certain ceiling limits, and that's what given here. If the book profits and the quantum of deduction, that's what we have to know. On the first 3 lakh worth book profit, or in the case of loss, then what is the quantum of deduction, or we can say what is the maximum ceiling limit that they can claim it as a deduction? It is either rupees 1,50,000 or 90% of the book profit, whichever is higher. All right. And on the balance book profit, they can claim 60% of the book profit as what? As their deduction. Say I'll give you one example also to understand this concept. Say for example, book profit of a partnership firm is say 10 lakhs. All right. Book profit of a partnership firm is say 10 lakhs. Now the question is under section 40B, how much we can claim as a deduction? What is the ceiling limit of deduction that can be claimed by a partnership firm while paying remuneration with partners? That's what we must know. So on the first 3 lakh, or in the case of loss, what is the ceiling limit? What do you mean by ceiling limit? Ceiling limit is the top limit that they can claim it as a deduction. All right. So the ceiling limit, it says either rupees 1,50,000 or 90% on 3 lakh, whichever is higher. So the 90% of 3 lakh will be 2,70,000. Whichever is higher definitely will be the 2,70,000. On the balance book profit, our total book profit is 10 lakh. On the balance book profit means the remaining 7 lakh. 7 lakh into 60% is the ceiling limit. Now what is 7 lakh into 60%? It would be 4,20,000. So in total what they can claim, 2,70,000 plus 4,20,000, it would be 6,90,000 rupees as a deduction. But this is the maximum limit. This is the ceiling limit. All right. Say if they have paid 5 lakh as remuneration, if they have actually paid 5 lakh as remuneration, then how much is the deduction? It is either the ceiling limit or the actual amount, whichever is lower. Yes or no? So here the partnership firm can claim this 5 lakh paid to its partners as a remuneration, because the ceiling limit gives them 6,90,000. Up to 6,90,000 they can give, but they have only paid 5 lakh, and hence the deduction under 40B also will be 5 lakh. So this was just an example. Now to the answer. So first option 1,50,000, second option 1,50,000 or remuneration paid whichever is lower, and what is the third option? 1,50,000 or 90% of the book profit, whichever is lower. This is actually wrong. And option number D is nil. So which is the correct option? It is option number B. All right. Either you can claim, in the case of loss, you can claim 1,50,000 minimum as a remuneration. Or if the actual remuneration paid by you is lesser than 1,50,000, then definitely that actuals you can claim it as a deduction under 40B. And hence to the final answer, 1,50,000 or remuneration paid, whichever is lower. I hope it is clear. All right. Now, moving on to the question number 2. So what question number 2? Which of the following is taxable under the head salaries? So out of this, you must say which of the following is taxable under the head salaries. So friends, for taxing an income under the head salaries, there are certain criteria. Criteria number 1, there should be an employer-employee relationship between the person who is in receipt of salary and the person who pays. All right. And the payment received by the employee should be in the status of salary. So these are the two cardinal principles for taxing an income under the head salaries. So here, salary received by member of state legislature. Okay, if a person, that means if you are a person being a member of state legislature, receives any amount, can you call it a salary actually? Even though it is named as salary, the question is, can you treat that amount as salary? The answer is no. Why? Because salary received by a member of state legislature, there is no employer-employee relationship between the state and that member. All right, even though it is called as salary, you cannot establish an employer-employee relationship there. So what will be the status? Whatever the payment received by the member will be taxable under IFOS. So before moving on to this, let me have a quick discussion on the heads of income. For taxing an amount under the head salary, there should be employer-employee relationship. And what about house property? For taxing an income under the head house property, that income should be receivable in relation to a residential or a commercial house property. So it is a residential or commercial house property. Or we can say not house property, residential or commercial property. House property or building or factory, etc. Whatever the rent received by you will be taxable under the head house property. Now, to tax an income under PGBP, that income should be either from your business or from your profession. So there should be a business or profession for taxing an income under PGBP. Then what about capital gains? For taxing an income under capital gains, there should be a capital asset. There should be a capital asset plus there should be transfer of capital asset. So there should be a capital asset and there should be a transfer of capital asset as well for taxing an income under capital gains. And what about IFOS? If the income is not taxable under the head salary, house property, PGBP or capital gain, then that income which forms part of scope of total income would be definitely taxable under IFOS. Hope you know this theory. All right. So moving on to that question, again, salary received by member of state legislature is not taxable under the head salary. It will be taxable under the head IFOS. Why? Because there is no employer-employee relationship between the state and the member. So moving on, commission received by the employee director of a company. All right. If an employee director, if the director is an employee of the company as well, then whatever payment received from that company to the employee or to the director will be taxable under the head salaries. So under the head salaries, since there is employer-employee relationship. So friends, there are different kinds of directors. Say for example, an independent director is actually not an employee of a company, but a whole-time director or a managing director can be an employee of the company. So if the payment is given by the company to a whole-time director or a managing director who is employee of the company, then definitely that sum will be taxable under the head salaries. All right. And if in the same circumstance, if payment is given by the company to an independent director who is not an employee of the company, then definitely there won't be any taxation under the head salaries. It will be definitely taxable either PGBP or IFOS. All right. Again, moving forward with the next alternative, family pension received. So you tell me what happens to family pension received under IFOS. What do you mean by family pension? Say for example, Mr. A is a retired employee, or say for example, is a working employee. he is dead. All right, he is dead, and the company is now paying a pension to his wife or his his close relatives, and that is actually called as what? Family pension. So Mr. A and the company, there is an employer-employee relationship between Mr. A and the company, but if the company is paying a pension to Mr. A's wife, that means Mrs. A, it is called as family pension. But there is no employer-employee relationship between the company and Mrs. A, and hence that particular family pension will be taxable under which head? Definitely under IFOS, not under the head salaries. So friends, what is the final answer to the question? So you are supposed to find out of this which income is taxable under the head salaries. So the answer is obvious. It is option number B. That means commission received by an employee director of a company will be definitely taxable under the head salaries. I hope that is also clear. Again, moving forward with question number 3, that is, a zero coupon bond shall be treated as a long-term capital asset if it is held by transferor for dash number of months. So the question is in relation to determination of whether a capital asset is a long-term or short-term. All right. So I'll repeat the question again. A zero coupon bond shall be treated as a long-term capital asset if it is held by the transferor for dash number of periods. So friends, before moving on to the answer, let me give you a few theories. All right. Normally, there are two kinds of capital asset. As you know, it is long-term capital asset and short-term capital asset. Long-term capital asset and short-term capital asset. Determination of this long-term capital asset or short-term capital asset is on the basis of period of holding of an asset. All right. So if the period of holding, in general, we can say if the period of holding is more than 36 months, if the period of holding is more than 36 months, then definitely an asset will be a long-term capital asset. And if the period of holding is less than or equal to 36 months, then that asset is called as short-term capital asset. But for certain category of assets, the period of holding for determining whether it is long-term or short-term is 12 months. Say for example, listed shares, zero coupon bonds, then units of UTI, etc. The period of holding for determining whether that asset is a long-term or short-term is based on 12 months. That means if the period of holding is more than 12 months, then those assets will be treated as a long-term capital asset. And if the period of holding is less than or equal to 12 months, then those assets will be treated as short-term capital asset. And certain other assets, for certain other assets, the period of holding is 24 months for determining whether it is a long-term or short-term. Again, unlisted shares, the period of holding to determine whether that shares is a long-term capital asset or short-term capital asset is based on 24 months. Again, for land and building, it is based on 24 months. If the period of holding is more than 24 months, definitely that land or a building can be called as what? Long-term capital asset. And if the period of holding is less than or equal to 24 months, land or a building can be definitely called as a short-term capital asset. Now let's come back to the question. This is a base theory for understanding that particular question. Now let's come back to the question. So the question is, a zero coupon bond shall be treated as a long-term capital asset if it is held by the transferor for dash number of months. So the answer is obvious. It is more than 12 months. I hope that is also clear. All right. So it is based on 12 months. Zero coupon bond, the period of holding criteria is based on 12 months to determine whether that asset is a long term or short term. So let's continue, friends. Question number 4. Quoting of permanent account number is compulsory in the following transactions. That's what we are discussing. Option number 1, payment to life insurance policy exceeding 50,000 in a financial year. Option number 2, sales or purchase of any immovable property valued at rupees 4 lakh. Option number 3, time deposit up to 35,000 with a bank. And option number 4, none of the above. So let's understand in which transaction quoting of permanent account number is mandatory. So this column will give you the right answer. So friends, please listen. Payment as life insurance premium to an insurer defined under Insurance Act 1938, quoting of PAN is mandatory if the amount aggregating to more than 50,000 in a financial year. So what do you mean by this? If you are making a payment and the payment is in relation to premium for life insurance, then if the premium amount exceeds 50,000 in a financial year, you are making a payment as a premium for your life insurance, and the aggregate payment in a year, if it is exceeding 50,000, then you have to mandatorily quote your PAN number. That's it. Income tax is not stating that you are not supposed to pay 50,000 or more. It only says if you are paying more than 50,000, you need to quote your PAN number with a transaction. That's what they are saying. All right. So point number 2, in case of sale or purchase of an immobile property, when you are supposed to quote your PAN, that's what it says. Quoting of PAN is mandatory if amount exceeding rupees 10 lakh. Say if you are purchasing an immobile property, say purchasing, or if you are selling an immobile property and the value of property or the sales value or the purchase value, if it is exceeding 10 lakh, then on such transaction, you are supposed to quote your PAN number. All right. And again, moving on, in the case of a time deposit with a banking company or a cooperative bank to which Banking Regulations Act applies, quoting of PAN is mandatory if amount exceeding 50,000 or aggregating to more than 5 lakh during a financial year. Say, for example, you are making a time deposit, right? You are depositing an amount in a bank or a cooperative bank. Then, if the single time deposit amount exceeds 50,000 or if the aggregate amount in a financial year exceeds 5 lakh, you are supposed to quote your PAN. So, these are the theory. Now, let's go back to the question. So, what they have asked, out of the following, in which transaction you are supposed to quote your PAN? So, the answer is obvious. It is option number A, right? So, option number A, it is very clear. Payment to life insurance policy. That means premium under a life insurance policy. If it is exceeding 50,000, then you must quote your PAN number, and hence the option is option A. The right option is option. Now, let's move on to question number 5. So, what is question number 5? An individual purchased a painting on 1/11/2021 for rupees 5 lakhs. All right. Through fair market value of, though the fair market value of the asset is 5,25,000, income tax payable under 56 subsection 2 clause 10 is dash. They have given 4 options. Option number A, rupees 25,000. That is the difference between the market value and the actual consideration. Option number B, nil, as this is not a gift. Option number C, nil, as the difference between the market value and the actual consideration does not exceed 50,000. Option D, the provision of 56 subsection 2 clause 10 is not applicable for any transaction entered during the previous year 2021. All right, so let's understand what exactly is the answer to this particular question. Please listen, friends. This question is in relation to IFOS. All right. So under IFOS, to be very precise, under section 56 subsection 2 clause 10, if you are receiving any gifts, say for example you are receiving a cash gift and the aggregate value of the cash gift received by you, if it is more than 50,000 rupees, then the entire sum will be taxable under IFOS. So let's move on. Moving on to question number 6. Question number 6 is interest relating to pre-construction period is allowable as dash 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 dash. There are 4 alternatives. You need to select the correct alternative. Option number 1, in 5 equal installments for the year in which it was incurred. Option number 2, in which the year it was in the year in which it was incurred. Or the option number 2, it says you can claim it as a deduction straight away in the year in which it was incurred. Option number 3, in the year in which the house property was constructed. Option number D, none of the above. So actually, you know, this is in relation to your house property, income from house property head. And under income from house property, if you have a house property and you have taken a loan for constructing a house property, then there are 2 kinds of interest. It is pre-construction interest and post-construction interest. Hope you know that theory area. If don't, please listen. Interest for pre-construction period and interest for the year in which the construction is completed, or commonly known as post-completion period interest. So pre-construction period is the period prior to the previous year in which the property is acquired or the construction is completed, ending on the 31st March immediately prior to the year of completion of construction. And the post-completion interest is the year or the interest from the year of completion and onwards. Now, the pre-construction interest can be claimed as a deduction over a period of 5 years in equal annual installments commencing from the year of acquisition or completion of construction. Again, interest relating to the year of completion or construction or acquisition of the property can be fully claimed in that year irrespective of the date of completion or acquisition. So friends, let's study this by way of an example. Say, simple example, Mr. JK have taken a loan on 1st April 2018. He has taken a loan of say 50 lakhs on 1st April 2018 at an interest rate of 10%. An interest rate of 10%. All right. So he was actually planning to construct a house. So the completion or the construction got completed on say 15th September 2020. So his construction got completed on 15th September 2020. So in this example, you need to understand which exactly is the pre-construction period. So what is pre-construction period? Pre-construction period, let's understand, it is the date from which the previous year or the period prior to the previous year in which the property is acquired or construction is completed, ending on the 31st March prior to the date of completion of construction. That simply means pre-construction period starts from the date of loan. That means it starts from 1st April 2018 and ends with. So tell me friends, which is the date of completion of that particular property? It is 15th September 2020 is the date of completion of that particular property. So always pre-construction period ends with 31st March 2020. That simply means what? Which is the year of completion? It is 2020-21. Yes or no? The year of completion is 2020-21. So from the year of completion onwards, from year of completion onwards, it shall be treated as a post-completion period. So pre-construction period is simply starts from the date of loan to 31st March of what? Of the preceding year of completion. So the year of completion is 2021. So always the pre-construction period ends with the 31st March of the preceding year of completion, and hence it starts from 2018 to 31st March 2020. Now, what is the treatment for pre-construction period? It's very simple. You must take the total amount of interest you have suffered during the pre-construction period. Say for example in 2018-19 and assume there is no principal repayment. Okay, assume in this loan there is no principal repayment. That particular person who has taken that loan is not repaying any principal. All right. So in 18-19 he must pay an interest of around 5 lakhs. In 19-20 also he must pay an interest of rupees 5 lakhs. So the pre-construction period is from 1st April 2018 to 31st March 2020. So the total pre-construction interest will be 10 lakh. So how can he claim this 10 lakh? It is claimed from the year of completion. From the year of completion onwards, you can claim that total pre-construction interest in 5 equal annual installments. That's what the act says. So friends, the point is very clear. The year of completion is 2020-21. From that year onwards, so how you can claim? Pre-construction interest will be 10 lakh divided by 5 into the first installment, right? So it will be 2 lakh is the portion of pre-construction interest that you can claim. And in 2021, there will be current year interest as well. All right, because in 2021 also there is loan and you are paying interest, right? So in 2021, there will be 50 lakh loan into 10% is the current year 2021 year's interest. So that will be 5 lakh again. So the total interest which you can claim in 2021 would be 7 lakh. 2 lakh is the 1/5 of your total pre-construction interest, and 5 lakh is the current year. That means 2021 years interest payment. Both you can claim it as a deduction from the year of construction onwards. Now let's get back to the question. So what is the question? It says interest related to pre-construction period is allowable as what? In 5 equal annual installment from the year in which it was incurred, or in the year in which it was incurred, or in the year in which the property was constructed, or none of the above. So tell me friends, what is the right answer? In 5 equal installments from the year in which it was incurred. It is wrong. 5 equal annual installment from the year of completion of property is the right answer. So that option is not available in the list of options here, right? So the answer is obviously D, none of the above. So all these three are wrong. So the right option is D, that is none of the above, because interest is allowable as a deduction, or pre-construction interest is allowable as a deduction in 5 equal annual installment from the year of completion of property onwards. All right? Yes. So moving on to option number 7, or question number 7, not option, question number 7. Maximum amount of leave salary not chargeable to tax as specified by the government in case of a non-government employee is dash. Again, these all are direct questions. Okay, so let's understand the exemption for leave salary. So first of all, friends, what do you mean by leave salary? What is leave salary? Say for example, you are taking a leave with wage, or say for example, I'll give you one example. Say for example, every company gives an option to their employees that they can say, for example, in a year, there is 30 leaves. All right. I'm being an employee. I'm taking only 10 leaves. I'm taking only 10 leaves in a year. So at the year end, I have worked for additional 20 days. 20 additional days. Yes or no? Because I could have easily taken 30 days leave. I've only taken 10 days leave. That simply means what? I've worked for an additional 20 days. Yes or no? On that additional 20 days, I could have definitely taken a leave, but I haven't. I've worked for that additional 20 days. So what I can do, I can encash this additional 20 days salary from my employer, because as per the company norms, I would have definitely taken 30 days leave. I've worked for that additional 20 days. I've taken only 10 days leave. So definitely, I will definitely ask what? I will definitely ask that 20 days additional salary. So that is normally called as leave salary. So, and under section 10(10)AA of income tax, if an employee at the time of retirement is taking out or withdrawing his entire leave salary, then what is this advantage? He can claim an exemption under 10(10)AA, and the exemption is as follows. If you are a non-government employee, the exemption will be as follows. Please listen. Either rupees 3 lakhs or leave salary actually received. 1 second, friends. Or leave salary actually received, or 10 months salary on the basis of average salary of last 10 months, or cash equivalent of leave based on 10 months average salary immediately preceding the date of retirement to the credit of employee at the time of retirement or death, and the earned leave entitlement cannot exceed 30 days for every year of actual service rendered for the employer from whose service he has retired. So what do you mean by this? These are the criteria for claiming an exemption under 10(10)AA. So what I've told you, if you are an employee and at the time of retirement, you are withdrawing your entire leave salary. If you are withdrawing your entire leave salary, then what happens? Then that entire leave salary will be taxable under the head salaries, yes or no? Because it is your salary anyways, and there is employer-employee relationship. Out of that entire leave salary which you have withdrawn, you can claim an exemption under 10(10)AA of income tax. And the exemption shall be least of the following. Either rupees 3 lakh, or the leave salary actually received, or 10 months average salary, or cash equivalent of leave to the credit of employee at the time of retirement or death. That means at the time of retirement or death, how much number of additional working days you have into the eligible salary. That is the fourth limit. Whichever is lower shall be the exemption. So let's go back to the question now. The maximum amount of salary not chargeable to tax as specified by the government in case of a non-government employee will be obviously what? It will be 3 lakhs. Why? Because say the first limit is anyways 3 lakh. Say the second limit is 4 lakh. And the third limit is say 5 lakh. And the fourth limit is coming 7 lakh. Then tell me friends, whichever is lower shall be the maximum exemption. And the lower figure will be obviously rupees 3 lakhs. And hence that is the maximum amount of exemption that you can claim as a deduction under 10(10)AA. And the answer is option B. I hope that is also clear. Now moving on to the 8th question. All right. So what is 8th question? On donation to whom of the following a 50% of deduction is allowable under 80G of Income Tax Act. So there is a speciality for section 80G. What is 80G? If you are giving out a donation, then depends upon the party to which you are donating, the exemption also varies. All right. So under 80G, there are 4 categories of donations. Hope you remember. Category 1, 100% is allowed as deduction without any limits. Category 2, 50% of donation is allowed as deduction without any limits. Category 3, 100% of the donation is allowed as deduction subjected to ceiling limits. And option number 4, 50% of the donation is allowed as deduction subjected to ceiling limit. So what the question says is, on donation to whom of the following a 50% of donation is allowable under 80G of Income Tax Act. So the first donation is given to National Defense Fund. So if you are donating anything to National Defense Fund, then what is the deduction? Donation qualifying for 100% of deduction without any qualifying limit. There is no qualifying limit, and whatever amount you have donated, that amount you can claim it as a deduction if you are donating to National Defense Fund. Moving on to the second donation, Prime Minister's National Relief Fund. If you are donating anything to Prime Minister's National Relief Fund, then donation qualifying for 100% deduction without any qualifying limit. In that donation also, you can claim 100% as a deduction without any qualifying limit. And what about the third one? Rajiv Gandhi Foundation. Again, donation qualifying for 50% deduction without any qualifying limit. So Rajiv Gandhi Foundation donation is actually allows for a 50% deduction without any ceiling limit. And finally, National Foundation for Communal Harmony. If you are donating to a National Foundation for Communal Harmony, then donation qualifying for 100% deduction without any qualifying limit. So in the question, what they've asked, out of this donation, which donation provides for a 50% deduction? So the answer is option C, Rajiv Gandhi Foundation. If you are donating anything to Rajiv Gandhi Foundation, then the deduction under 80G would be obviously 50% of whatever you have contributed without any ceiling limits. And the option is option C. And moving on to question number 9, it's actually a very direct question. Best judgment assessment is covered under 143 subsection 3. So friends, what is 143 subsection 3? This is related to your assessment procedure chapter. 143 subsection 3 is regular assessment. Now, what about 143 subsection 1? It is your summary assessment. 144 is the best judgment assessment. And 147, income escapement assessment. So what is the question? Question says best judgment assessment is covered under which section? 144. The option is C, direct question. So what is regular assessment? Regular assessment simply means a simple cross-examination of the returns filed by you by the department. All right, to check whether there is any underpayment of taxes, or whether there is any fake expenses, etc., etc. Now, what is 143 subsection 1 summary assessment? The department automated software will check certain basic things on every return filed by the assessee. Say, for example, to check whether there is any arithmetical error, or whether there is any error which is apparent from the records, or whether there is any mismatches with 26 AS or Form 16 with the return filed by you, etc., etc. And what is 144 best judgment assessment? If an assessee is not filing return, or if he is not cooperating to any proceedings initiated by the department, then the department officer will use his judgment to complete an assessment, and that process is called as what? Best judgment assessment. It simply means the assessing officer, whoever assesses, will use his judgment, his judgmental power to complete an assessment if the assessee is not cooperating. So that is best judgment assessment under 144. And what is 147? Income escapement assessment. If there is an income escapement done by an assessee, then the department will send him a notice and will reassess his escaped income again under section 147. So these are the 4 sections, and that is the end of question number 9 as well. Now moving on to the last question of part 1, that is unabsorbed business loss cannot be carried forward for more than. So it is unabsorbed business loss. So under section 72, what is the limit for unabsorbed business loss? You can carry forward it to subsequent 8 assessment years. And whenever there is a profit from your business or profession, you can definitely set it off. So what is the answer? Unabsorbed losses cannot be carried forward for more than 8 assessment years, and the option is option number B. All right. So that is the right answer. Under section 72, unabsorbed business loss can be carried forward to subsequent 8 assessment years, and you can set it off whenever there is a business profits. So friends, that is the end of part 1. That means the MCQ sessions are actually over. Now part B. All right, part B, that is fill in the blanks with suitable answers. It is fill in the blanks with suitable answers, only easy options. So question number 1, the maximum ceiling limit for exemption under 1010C with respect to compensation received on voluntary retirement is dash. Say for example, you are an employee and you are applying for a voluntary retirement. All right. So whatever the compensation received by you at the time of your voluntary retirement will be taxable under the head salaries. So that compensation will be definitely taxable under the head salaries. Now out of that compensation, you can claim an exemption under section 1010C of Income Tax Act. So the exemption under 1010C with respect to compensation received on voluntary retirement shall be minimum of the following. And how much it is? Either actual amount received as per the guidelines. That means whatever compensation you have received at the time of voluntary retirement is the first limit. Limit number 2, rupees 5 lakh. Limit number 3, the amount equivalent to 3 months salary for each completed year of service. So at the time of voluntary retirement, what you have to take? You must compute the number of completed year of service. Number of completed year of service into 3 months salary, whatever the amount comes in, that is the third limit. And moving forward, salary at the time of retirement multiply by the balance number of service left is the fourth limit. What do you mean by that? So whatever is your salary at the time of voluntary retirement, take that into multiplied with the balance number of service left. See, voluntary retirement means what? Even before your actual retirement age, you are applying for a retirement. That is voluntary retirement, right? So the fourth limit is salary at the time of retirement multiplied by the balance number of service left. So whatever that amount comes in will be the fourth limit. So whichever is lower shall be the maximum exemption that you can claim under 1010C. Now the question is also asking, what is the maximum limit of exemption that you can claim under 1010C? And the answer is maximum exemption is what? Whichever is lower, and the amount will be, the maximum amount will be always 5 lakh. I hope that is also clear. This is only an easy question. All right. Now, moving forward with option or question 2 in the fill in the blanks area. That is, Mr. Raju received 90,000 rupees in June 2020 towards a recovery of unrealized rent, which was deducted from his actual rent during the previous year 17-18 for determining annual value. The legal expenses incurred in relation to unrealized rent is 20,000 rupees. The amount taxable under section 25A for assessment year 21-22 would be. Now, question number 2, what they are asking, Raju received 90,000 in June 2020 towards recovery of unrealized rent, and which was deducted from the actual rent during 17-18. So friends, tell me, what is the treatment for receipt of unrealized rent? What is the treatment in income tax? Unrealized rent will be taxable in the year in which it is actually received, yes or no? So that unrealized rent will be taxable under the head house property, and you can claim a standard deduction from that unrealized rent as well. So in this question, the actual unrealized rent received by you is 90,000. So from 90,000, you can take a 30% as standard deduction, and that will be 27,000. And the remaining 63,000 will be taxable as what? As income from house property. Now the question is, can you claim any expenses in relation to unrealized rent received? The answer is no. The only deduction that you can claim from unrealized rent is what? The standard deduction of 30,000. Sorry, 30%. All right. So from that 90,000 unrealized rent, 30,000 standard deduction will be 27,000, and the remaining 63 will be definitely taxable under the head house property. So the answer is obviously 63,000. So that is option or question 2 under the fill in the blanks category. Now what about question 3? An electricity company charging depreciation on SLM on each asset separately sells one of its machinery in April 2020 at 1,20,000. The WDV of the machinery at the time of beginning of the year, that is on 1st April, is 1,35,000. No new machinery was purchased during the year. The shortfall of 15,000 is treated as dash. So friends, before explaining or before moving on to the answer, let me explain the concept of terminal depreciation and balancing charge. Say if you are an assessee, if the assessee being an electricity company, that means in the business of either generation of electricity or generation and distribution of electricity. All right, if you are an electricity company and you can opt for SLM computation of depreciation in income tax. Only electricity company or only those assessees who are engaged in the business of generation of electricity or generation of distribution of electricity can opt for SLM basis. All other assessees have to mandatorily opt for WDV basis. All right. And say again, this electricity company has an option. They can either opt for SLM or they can opt for WDV. But for all other kinds of assessee, they have to mandatorily follow the WDV method. So in this question, they are asking about SLM method. All right. Now, what is the question? An electricity company charging depreciation on SLM on each asset separately sells one of its machinery in April 2020 for 1,20,000. So the sales value of a plant and machinery is 1,20,000. And now what they are asking, the WDV of the machinery at the beginning of the year was 1,35,000. So at the time of sales, the same machinery has a WDV value of 1,35,000. And what they are asking is, no new machinery was purchased during the year, and the shortfall of 15,000 is treated as dash. So the WDV is 1,35,000 and your sales value is 1,20,000. So what is the shortfall? The shortfall is around 15,000. That 15,000 is definitely treated as what? Terminal depreciation. Terminal depreciation. And what is this terminal depreciation? If an assessee opting for SLM basis is selling an asset for a value which is lesser than the WDV value, then the difference have to be treated as a terminal depreciation and can be charged under section 32 as a deduction from their taxable profits. I hope that is clear. And what if the value is more than the WDV value? Say for example, what if the sales value is 1,40,000 and the WDV value is 1,35,000? What will happen? Then there is a gain because your WDV value is only 1,35,000 and you are selling it for 1,40,000. Then in that case, there is a gain. And the gain of 5,000 rupees will be taxable as what? Balancing charge under section 41 under PGBP. Hope you remember this concept. Balancing charge versus terminal depreciation. So if an assessee has opted for SLM basis and is selling that particular asset for a value which is lesser than WDV value, then the difference, that loss, will be terminal depreciation. And if it is a gain, then it will be balancing charge. Now what if the original purchase price of the plant and machinery is 2 lakh and the WDV value at the time of sale is 1,35,000 and the sale value is, say for example, 2,20,000. Then what should be the treatment? If the sale value is 2,20,000, WDV value 1,35,000, original purchase price of the plant and machinery 2 lakh, then what you have to do? Then what you have to do is, whatever sales price over and above the original purchase price will be short-term capital gain. That means the 20,000 here will be short-term capital gains, and the difference between the purchase price and the WDV value, that is 2 lakhs minus 1,35,000. The difference between the purchase price and the WDV value, it would be 65,000. Yes or no? That 65,000 would be definitely taxable as balancing charge. So what is the concept? If you are opting for a if you are opting for SLM basis, then the difference between the sales value and the original purchase price will be always short-term capital gain. All right, and the difference between the WDV value and the purchase price will be treated as what? Balancing charge as well. I hope that is also clear. So the right option is that difference is 15,000 will be treated as what? Terminal depreciation. Option, it's not an option. Question number 3, fill in the blanks. All right. Now moving on to question number 4. It is the deduction in respect of interest on enhanced compensation of 1,50,000 received during the previous year 2021 would be dash. Easy question. So if you are in receipt of interest on enhanced compensation, what do you mean by interest on enhanced compensation? Say there is a delay in the receipt of enhanced compensation. Then along with the enhanced compensation, you will get an additional interest for that delay. So what is enhanced compensation? Your property is actually compulsorily acquired by the central government or state government. They will decide an initial compensation for you. And you are saying this initial compensation is not adequate. We need more compensation. And you are filing a case against the state government or central government department. And say the court is giving you an additional compensation. Over and above initial compensation, the court is giving you an additional compensation. That additional compensation is normally known as what? Enhanced compensation. So whatever compensation you have received over and above the initial compensation will be called as enhanced compensation. That enhanced compensation, initial compensation, etc. will be taxable under capital gains. But if you are in receipt of what? Interest on enhanced compensation, then what will happen? That interest will be definitely taxable under IFRS, and from that interest you can claim 50% as a straight away deduction, just like a standard deduction. Whatever you are receiving as an interest, from that you can claim 50% as a standard deduction, and out of this 1,50,000 you can claim 50% as the standard deduction, and the remaining 75,000 will be only taxable under IFRS. Is that clear, friends? I hope you are able to follow whatever I'm saying. Okay. Yes. Moving on to the 5th element of fill in the blanks, that is brought forward loss from house property can be set off. Dash. If you have a brought forward loss from house property, then you can set it off from income from house property without any limit, right? What do you mean by brought forward loss of house property? Say in 1 year you have a loss from the head house property. In that year you were not able to set it off with any other profit, so you will take that loss to the next year, and that is normally known as what? Brought forward loss from house property head. If there is a brought forward loss from house property head, then what is the treatment? You can definitely treat that as a loss and carry forward to the next year, and in the next year, if there is income from house property, then you can set it off. So let's move on to true or false. So you need to state whether the following are true or false from the following questions. All right. So no tax is required to be deducted from winnings from racehorse if such winnings does not exceed rupees 10,000. Winnings from race horses, or we can say horse races. All right. If you have that winnings, then TDS is required to be deducted under 194BB only if that winnings is over and above 10,000. All right. So this statement is definitely true. So here is the 194BB extract. It is TDS on winnings from horse races under 194BB. Who is the deductor? Every person responsible for paying such sum. Whoever pays that particular winnings from horse races, that person is supposed to deduct TDS. And what is the rate? Rate is at normal 30%. And what time TDS is required to be deducted? It is required to be deducted at the time of payment. All right. And finally, there are certain thresholds as well. And what is the threshold? No tax is required to be deducted if the winnings amount is less than 10,000. If that winnings amount is less than 10,000, then TDS under 194BB is not required to be deducted, and we can say this option is what? It is true. I hope it is clear. Now friends, moving forward to the second statement, allowances payable to central government employees for serving outside India is not exempted. That's a statement, and you are supposed to say whether it is a true statement or a false statement. All right. So allowances payable to central government employees for servicing outside India is not exempted. It is false. Under section 10 subsection 7, there is an exemption to the allowances if it is paid to the central government employees for servicing outside India. Say for example, our IFS officers who are serving in Indian embassy which is situated in a foreign country, if our government is giving them some kind of allowances, whatever the allowance be, that entire allowances will be exempted in their hands under 10 subsection 7. So the allowances and perquisites paid or allowed outside India by the government to an Indian citizen for services rendered outside India is fully exempted under 10 subsection 7, and hence this statement is false. Now, moving forward with the third statement, short-term capital gain arising from sale of listed shares through a recognized stock exchange for which security transaction tax has been paid will be charged to tax at concessional rate of 15%. So what do you mean by this? Say for example, you have some listed shares. All right. And this is a short-term capital asset. At the time of purchase and at the time of sales, you are paying security transaction tax. STT means if you are purchasing a listed share or if you are selling a listed share, you must pay a small amount of the transaction value as security transaction tax as per the Finance Act. All right. And you are suffering STT as well. So whatever be the short-term capital gain, that will be taxable under section 111A at a flat rate of 15%. So that's what Income Tax Act states. Now let's move on to this question. Short-term capital gain arising from sale of listed shares through a recognized stock exchange for which security transaction tax has been paid is chargeable to tax at the rate of 15%. The statement is true. The section is 111A. So that statement is definitely true, and the answer is also clear, I hope. Moving on with the fourth alternative. Income arising from accretion of transferred property shall not be clubbed. It is in relation to clubbing of income. If you are transferring an income without transferring asset, definitely clubbing provisions will be there. If you are transferring an asset without inadequate consideration, there also clubbing provisions will attract. So what here they are saying, income arising from accretion of transferred property shall not be clubbed. So what do you mean by accretion of transferred property? say I will give you a simple example to understand the concept of accretion income. All right, we normally call this as accreted income. So friends, please listen. Say Mr. X, Mr. A, we will call him Mr. A. He transferred a property, a house property, to Mrs. A. Instead of house property, I will call it as, say, debentures of value 10 lakhs. Value 10 lakhs to Mrs. A. All right, without any consideration. Now, Mrs. A, what she have done, she sold that particular property. She sold that particular, not property, sold that particular debentures, say for 12 lakhs. Sold that particular debentures for 12 lakhs. And there is a profit of 2 lakhs. There is a profit of 2 lakhs. This 2 lakhs will be definitely clubbed in the hands of Mr. A, because Mr. A has transferred that particular debentures free of cost to his wife, and definitely clubbing provisions will attract. All right. Now, this profit of 2 lakhs is with Mrs. A, but for the purpose of taxation, it will be clubbed, or it will be treated as an income of Mr. A, and it will be taxed in the hands of Mr. A. But this 2 lakh is now with Mrs. A. Yes or no? Now, Mrs. A is investing this 12 lakhs in 10% preference shares. Say Mrs. A is investing this entire 12 lakhs in 10% preference shares. Now, she is getting an annual income of 1,20,000. She is getting, that means Mrs. A is getting an annual income of 1,20,000. Now, the question begins. This 1,20,000 is from an investment of this 12 lakh. Yes or no? This 12 lakh is, out of this 12 lakh, 10 lakh is actually the worth of debenture, and 2 lakh is the profit on sale of debentures. So out of this 1,20,000, we can say 1 lakh is from the worth of debentures and 20,000 is from the profit on sale of debentures. Yes or no? Out of this 1,20,000 dividend receipt on account of 10% preference shares, we can say 1 lakh, out of this 1,20,000, 1 lakh is from the worth of debenture value, and 20,000 is from that profit portion. Yes or no? And hence the conclusion is very simple. The income of 20,000 is actually earned from the profit, and that 20,000 is not to be clubbed in the hands of Mr. A, because income from accretion of transferred asset, the transferred asset is debenture, and you have earned a profit of 2 lakh from that transferred asset. Hence, that 2 lakh will be income from, or 2 lakh will be accretion of transferred asset. And now, if you have invested that 2 lakhs elsewhere and you are getting a profit, then it is called as income from what? Accretion of transferred asset. This 2 lakh is the accretion of transferred asset. And if you are incurring an income from that 2 lakh investment, that 2 lakh investment income will be treated as what? Income from accretion of transferred asset. And that portion of income is not required to be clubbed. And hence, out of this 1,20,000, this 20,000, there will not be any clubbing element. All right. Now let's go back to the question. What it says, income arising from accretion of transferred property shall not be clubbed. It is true. It is true only because, as I've told you, if there is some accretion from the transferred asset, then you are investing that accretion and you are getting a income from that accretion. That income is not to be clubbed with the original transferor. I hope that is also clear. Now moving on to the last fill in the blanks question area. Question number 5. It is, loss in speculation as well as non-speculation business can be carried forward to the maximum of 4 consecutive assessment years immediately succeeding the assessment year for which loss was first computed. Straight away you can say the statement is false. Why? If there is some loss from speculation business, if there is some loss from speculation business, then that can be carried forward to subsequent 4 years only. And if there is some loss from normal business, that can be carried forward to subsequent 8 years. So in this statement, what they are saying is loss in speculation as well as non-speculation, that means normal business loss, can be carried forward to a maximum of 4 consecutive years. In the case of a non-speculation business, that means a normal business, you can carry forward it to up to 8 years. And hence this statement is actually false. All right. So that is the end of this true or false area. So let's move on to category D. All right. Let's move on to category D. Based on the paragraph given below, choose the right option. So it is just like a passage. You have to read the passage. After that, you need to give the right answer by making use of that particular passage. All right. So let's study this. For assessment year 21-22, Mr. Sonu submits the following information. So which are the information? There is particulars, building at Chennai and building at Cochin. All right. So let's go through this paragraph. Municipal valuation of building at Chennai is 35,000 and building at Kochi 80,000. Standard rent 36,000, building at Chennai, at Kochi 70,000. Fair rent, building at Chennai 31,000 and at Kochi 82,000. Rent received, building at Chennai 38,000 and at Kochi 68,000. Moving forward, municipal taxes paid by tenant Mr. Ramu for building at Chennai and paid by Mr. Sonu for building at Kochi is 3,000 and 4,000. So friends, the first thing you must note here is, who is the assessee here? Who is the assessee? Mr. Sonu is the assessee. All right. Because Mr. Sonu has a property in Chennai and at Kochi as well. All right. Now, he has rented out this property and the actual rent received is 38,000 for Chennai and 68,000 for Cochin. Now, the municipal tax for the property in Chennai and Cochin, in the case of property in Chennai, it is paid by tenant Mr. Ramu. And in relation to property in Cochin, it is paid by Mr. Sonu himself. So this 3,000 is paid by the tenant. And this is paid by the owner. That means Sonu. We'll note down all the critical points of this question so that it will be easy for us to read the questions and give out the answers. All right. Now, repair paid by the tenant Mr. Ramu for Chennai building and Mr. Sonu paid for Kochi building is 518,000. Now, land revenue paid is 2,000 and 16,000. Insurance premium paid is 500 and 2,000. Please listen. Interest on loan borrowed for payment of municipal tax of the house property. All right. It is 200 and 400. Now, nature of occupation is let out for residence. It is the another one is in Kochi is let out for business. And finally, the date of completion of construction is 1/4/1996. That is in relation to property in Chennai. And 1/7/2008. That is in relation to property in Kochi. All right. Now, Mr. Sonu is constructing one more building in Mumbai during the previous year. Mr. Raju, a film director, took on rent the building under construction in Mumbai at 5,000 per month for his film shooting. All right. Now, the construction of the said building would be completed by April 2021. And Mr. Sonu is a real estate developer and letting out properties is not the business of Mr. Sonu. So, letting out the properties is actually not the business of Sonu. And hence we can say all the rental incomes will be taxable under which head, friends? Please respond. If letting of property is not the business of Sonu, you tell me, all the rental incomes will be taxable under which head? Please respond, friends. If letting of property is not the business of Sonu, then all the income from rental activity will be taxable under house property itself. All right. Now, moving forward, Mr. Sonu is a real estate developer and letting out of property is not the business of Sonu. Now, based on the facts of the case, scenario given above, choose the appropriate answer to the following questions. So, based on this paragraph, you must answer the following questions. All right. So, let's go through this particular questions. Which of the building income is chargeable to tax under income from house property in the hands of Mr. Sonu? So, out of this, which of the incomes are taxable under the head house property? That's what they are saying. So, from the paragraph itself, it was very clear. He has actually a property at Chennai. Then he has a property at Kochi. And he has a property which is under construction. The property under construction in Mumbai as well. So the question or the paragraph states about 3 properties. All right. Number 1 in Cochin and number 2 in, number 1 in Chennai, number 2 in Cochin and number 3 in Mumbai. Now, what about there is a rental income from Chennai? Definitely it will be taxable under house property because renting a property is not his business. Now, what about the rental incomes from Cochin? Definitely it is also taxable under house property. So it will be taxable under house property head. And finally, what about that income received from Mumbai property, friends? So what about the income received from Mumbai property? Tell me. Now the question is whether the completion of Mumbai property or the construction of Mumbai property is over or not. The construction is actually not over. It is under construction. And some director took it for film shooting. Yes or no? And there is an income received from the property which is under construction, and you cannot tax that income under the head house property. Why? Because if you want to call a property as a house property, then the completion should be there. Then the construction should be completed. Then only you can call a property as what? A house property. All right. So this particular thing is only a construction site. That particular property can be called as only a construction site. If the construction is completely over, then you can call it as a house property. All right. Now tell me, friends, what will be the impact of rent or amount received from the film director for shooting purpose? That will be definitely taxable under IFOS. Yes or no? If a property is not completed, if the construction is pending, then you can call it as only a construction site. All right. So whatever income you have received from that construction site will be definitely taxable under IFOS, not under house property. So what happens is the answer, let's move on to the options we have. What are the options? The question is, out of which of incomes will be taxable under income from house property? Building at Chennai only, it is wrong. Building at Kochi only is also wrong. Both buildings at Chennai and Kochi, I think that is the right answer. And option 3, all the 3 buildings at Chennai, Cochin and Mumbai. So tell me, friends, what is the right answer? It is option number C. Both buildings at Chennai and Cochin can be definitely, incomes from Chennai and Cochin can be definitely taxable under house property head. Okay? All right. Now, friends, let's move forward. Moving on to question number 2, based on the paragraph. Which of the following payments or expenditure is allowable as a deduction while computing income under the head income from house property incurred in respect of building at Chennai and Cochin? So what they have asked is, you are supposed to compute all the allowable expenses in relation to building at Chennai and Cochin, all right, under the house property head. All right. Now, friends, let's move on to the, deductions we can claim. So generally, from house property income, which are the deductions that you can claim? Number 1, you can definitely claim municipal tax if paid by the owner, right? Number 2, you can claim standard deduction of 30%. All right. And number 3, you can claim interest on loan taken to purchase or construct or repair or renovate a house property. So these 3 are the main deductions in house property. Yes or no? These 3 are the main deductions in house property head. Now let's move on to the question. Which of the following payments or expenditure is allowable as a deduction while computing income under the head income from house property incurred in respect of building at Chennai and Cochin? Option A, municipal taxes paid by Mr. Sonu and Mr. Ramu. Option B, municipal tax, land revenue, insurance premium, interest on loan borrowed for the payment of municipal tax by Mr. Sonu. Option C, only municipal tax paid by Mr. Sonu. Option D, both municipal tax and repairs paid by Mr. Sonu. So tell me friends, which is the right answer? Out of these four options, which is the right option? Let's go through option number 1 again. Municipal tax paid by Sonu and Mr. Ramu. Can it be claimed as a deduction from the head house property by Mr. Sonu? No. Because municipal tax, if paid by Ramu, the tenant, then how can the owner claim a deduction? It is not possible. If the owner wants to claim a deduction, then he must himself or he himself must pay that particular municipal taxes. Yes or no? So first option is actually wrong. What about the second option? Municipal tax, land revenue, insurance premium, interest on loan, etc. can be claimed as a deduction by Mr. Sonu. Insurance premium, land revenue, etc. cannot be claimed as a deduction under the head house property. There is only 3 deductions. Either municipal tax paid by the owner or not, or along with that you can claim a 30% standard deduction. Along with that you can claim interest paid on loan for construction or purchase of that house property also as a deduction. So option number 2 is also wrong. Anyways, land revenue, insurance premium, all those things cannot be claimed as a deduction. Option number C, only municipal tax paid by Sonu. Municipal tax paid by Sonu, definitely you can claim it as a deduction. And option number D, both municipal tax and repairs. Can you claim repairs as a deduction from house property head? The answer is no. You cannot claim repairs paid as a deduction from the head house property. For all expenses in relation to house property, the income tax is giving you a standard deduction of 30%. Apart from standard deduction, you cannot claim, you are not supposed to claim any repairs or any painting charges or any insurance charges, etc. in relation to house property. It is not allowable. So what is the right answer out of this option? Option number C is the right answer. Only municipal tax paid by Mr. Sonu is allowable as a deduction. So we were discussing question 2. So let's move on to question number 3 based on the paragraph or based on the passage. Under which head of income the amount received from Mr. Raju would be chargeable to tax? All right. Under which head of income the amount receivable from Mr. Raju would be chargeable to tax? So who is Mr. Raju? Let's understand who is Mr. Raju. Mr. Raju is the film director. From the paragraph, it is very clear. Mr. Raju is actually a film director. And he has taken that particular property under construction for his film shooting. All right. Now the question is, under which head of income the amount received from Mr. Raju would be taxable? We have already discussed that. You tell me, under which head that amount received by Mr. Raju, received from Mr. Raju, a film director, will be taxable in the hands of Sonu? It will be definitely under IFOS, and the option is C. Income from other source, and the option is definitely option C. Moving forward to question number 4, alternative number 4, based on the paragraph. What is the amount chargeable to tax under income from house property in the hands of Mr. Sonu for the previous year 2021? So you are supposed to compute the income taxable under the head house property in the hands of Mr. Sonu. So let's move on to computation of income under the head house property. So computation of income under house property. All right. So how to compute the income under the head house property? So this particular Sonu has actually 2 house properties. Yes or no? Sonu has actually 2 house properties. Number 1 at Chennai, number 2 at Kochi. So at Chennai, at Kochi. So the first step while computing house property income, what is the first step? You need to consider the fair rent of house property. Compare it with the municipal value, and whichever is higher shall be taken. So let's compare the fair rent and municipal value first. So what is the fair rent? Fair rent in the question, it is for property at Chennai, the fair rent is 31,000 and municipal value is 35,000. So whichever is higher means the municipal value 35,000. All right. So we will take 35,000 being the higher among fair rent and municipal value. Now, what about the property in Cochin? The fair rent is 82 and municipal value is 80. So 82 shall be selected, being the higher one among the alternatives. Now, you need to compare this element with the standard rent, and whichever is lower shall be picked. All right. So let's see what is the standard rent. So the standard rent for Chennai property is 36 and the municipal value is 35. So whichever is lower means what is the correct option? 35,000 is the correct option. So 35,000. And this 35,000 is also known as expected rent. Expected rent from that particular property. Now, what about the property in Chennai? Your standard rent is around 70,000 and the other alternative is 82. So whichever is lower means the 70,000 will be the expected rent. So no. So 35,000 and 70,000 are the expected rents there. Now we will compare it with the actual rent, and whichever is higher shall be normally selected. But if the actual rent is less due to vacancy, then gross annual value will be the lower figure. Yes or no? If the actual rent is lower due to a vacancy element, then definitely that actual rent will be selected as gross annual value. Now let's compare the actual rents. What is the actual rent? In the first case, rent received is 38. Rent received is 38,000. And in the second case, the rent received is 68,000. 68,000. Now friends, what you are supposed to do, you need to take gross annual value now. GAV. How to compute GAV? Normally you compare expected rent and actual rent, and whichever is higher shall be selected as gross annual value. So here, which is the higher amount in the first case, it is 38,000. So gross annual value will be 38,000. And in the second case, what is the higher amount? 70,000 is the higher amount. So 70,000 is the gross annual value. In the question, they are actually silent about any vacancy because we don't know whether there is any vacancy or not. So our assumption is there is no vacancy. Since there is no specific mention in relation to vacancy, we are assuming that the vacancy is 0 or nil. There is no vacancy. All right. From the GAV, what is the next deduction? It is the municipal tax paid by the owner. So friends, tell me, municipal tax paid in relation to property in Chennai. Who pays the municipal tax in relation to property in Chennai? It is actually paid by Mr. Ramu, the tenant. All right. Mr. Ramu, the tenant, paid the municipal tax in relation to property in Chennai. So can Sonu claim it as a deduction? No. Sonu is not supposed to claim it as a deduction. So it's gone. Now, what about the property in Cochin? The property in Cochin, the municipal taxes is actually paid by Sonu himself, and that amount is 4,000. So definitely Sonu can claim it as a deduction. And now let's compute the net annual value. It is 38,000 rupees, and there it is 66,000 rupees. All right. From the net annual value, assessee can definitely claim standard deduction at the rate 30%. Now 38,000 into 30%, it would be 11,400. And now 66,000 into 30%, it would be 19,800. These are the standard deduction amount. Now the question is whether there is any interest on loan taken for construction of the property. Is there any interest on loan taken for the construction of property, friends? Let's go through. There is an interest on loan borrowed for payment of municipal tax of house property. Can you claim it as a deduction? Can you claim that interest on loan which is actually taken to pay the municipal taxes? No, you cannot. If that property loan is for the construction or repair or expansion or purchase of the property, then definitely you get. Otherwise, you cannot. All right. So what you're supposed to do, there is no deduction for interest. And now let's compute the income from house property. Income from house property would be 38,000 minus 11,400, and that is 26,600. And in the other case, 66,000 minus 19,800, and that would be 46,200. All right. And in total, what is the total amount coming? In total, what is the total amount? 46,200 plus 26,600, it would be 72,800. Now let's check whether there is an answer of 72,800. If not, then it is wrong. All right. So let's check whether there is any 72,800 in the question. Yes. 72,800, it's the first option itself is 72,800, and that is the right answer. All right, option number A is the right answer. I think that is the end of that paragraph question. Now let's move on to proper numerical as well as the other questions. All right, so next is question number 2. So please listen, friends. Question number 2, it is a theory question. What is tax evasion? So it's a very simple question. Tax evasion. You need to define the concept of tax evasion. So the statutory definition and the explanation I have given here. Tax evasion is illegal way to reduce tax liability by deliberately suppressing income or sale or by increasing expense, etc. So tax evasion simply means, say you are claiming some fake expenses or you are not disclosing your income. Say I have an income of 10 lakh, but in return I am only stating 6 lakhs as my income. So there is a suppression of 4 lakhs. So that process is called as what? Tax evasion. It is immoral as well as it is illegal. All right. So which result in a reduction of total income of the assessee. So definitely if you suppress income or if you claim fake expenses or if you deliberately suppress your sales, definitely your income will come down. Your total income will be come down so that the tax liability also will be comparatively less. All right. Now, the tax evasion is illegal both in script and moral. It is cancer of modern society and work as a clog in the development of nation. So it is actually a suggested answer given in your previous MTP itself. So what they are saying, it is a cancer of modern society and work as a clog in the development of nation. Because how it affects the development of nation, how it is if you are paying less tax. Say you are supposed to pay some tax, and if you are suppressing your income, you are paying less tax compared to the actual tax liability, right? So that the nation development will be in trouble. That's what they are saying. So that is the answer for that particular question. And I think there is no need for any further clarification because it is only a direct theory question and you can go through that particular question by yourself. Again, moving on to the question B under 2, second question B part. So it is actually a very interesting question. Mr. Britley, an Australian cricket player, visits India for 100 days in every financial year and has been in practice for past 10 financial years. So what we will do, we will note down the important point. So Mr. Britley, I will call him as BL. So what he has done, he has visited India. He's an Australian cricket player. And he visited India for 100 days in every financial year, and this has been in practice for the past 10 financial years. So every year he visits India. Every year he visits India for 100 days. And this has been in practice for the past 10 financial years. All right. Now, find out his residential status for assessment year 21-22. Then, would your answer change if the above facts related to Mr. Srinath, an Indian citizen who resides in Australia and represents the Australian cricket team? And what would your answer if Srinath has visited in India for 120 days instead of 100 days every year, including the previous year 2021? So, based on this, they have asked you 3 questions. All right. So, let's answer all of these 3 questions. We will start from question number 8. Find out his residential status for assessment year 21-22. So the relevant PY in the question is 2020-2021. 2021 is the relevant previous year. So in 2021, he visited India for 100 days. All right. In 1920 also, he visited 100 days. 1819 again visited 100 days. So it is like that. For the past 10 years, the trend is like that. Every year, he comes to India for the purpose of his cricket practice or something. So how to determine the residential status? What are the conditions for determining residential status? Do you remember? A person is said to be in India is based on his number of days of stay in India, yes or no? If that person is staying in India for more than 182 days, or we can say 182 days or more, if he is staying in India in the relevant previous year, that person can be called as a resident. All right. And there is one more alternative condition under section 6. What was that? In the relevant previous year, if a person is staying in India for 60 days or more, and in the preceding 4 previous year, if his aggregate days of stay is more than 365, or we can say 365 days or more, in that situation also, he is a resident in India. So I will note down that condition is days of stay in India in the relevant previous year is 182 days or more, he will be a resident. That is first condition. Then his days of stay in India in the relevant previous year, there is an OR condition. His days of stay in India in the relevant previous year is 60 days or more, and in preceding 4 previous years, total days of stay in India is 365 days or more, then also he can be called as a resident. Now let's move and check the residential status of this person. So Britley, in the relevant PY, stayed for 100 days. So the first 182 days condition is anyways not applicable because the relevant PY, he stayed only for 100 days. All right. And let's check on the next condition. That means for relevant PY, he stayed in India for 60 days or more. Yes. And in the preceding 4 previous year, that means in 1920, then 1819, then 1718, then 1617. That is the preceding 4 previous years. Every year he stayed in India for 100 days. So his total days of stay in the preceding 4 previous years will be 400 days. Yes or no? So what is the final answer? Definitely he can be called as a resident. Have you got it, friends? Please respond. His days of stay is more than 60 in the relevant PY, and in the preceding 4 PY, his total or aggregate days of stay is 365 days or more, and hence the final verdict is he's a resident. Now, if a person is resident, then what is the next thing that you have to check? Whether he's a ROR or RNOR. There's a concept called resident and ordinary resident, and resident but not ordinary resident. All right. Now let's check whether he's a ROR or RNOR. Do you remember which all are the conditions for checking whether a person is ROR or RNOR? Let's understand. Let's go through that conditions for checking a person is whether ROR or RNOR. All right. So as you can see it from here, an individual not being an Indian resident would be not ordinary resident if he satisfies any of the conditions specified under section 6 subsection 6. A person is a resident. Now you are going to determine whether he is a ROR or he is a RNOR. RNOR means resident but not ordinary resident. Now, an individual being an Indian citizen, not being an Indian citizen, if he is a foreign citizen, he would be not ordinary resident person if he satisfies any of the conditions specified under section 6 subsection 6. And what is that first condition? Please listen. If such individual has been a non-resident in India, if that person is a non-resident in India in 9 out of 10 preceding previous years relevant to the previous year. So let's check that first condition. What they are saying, the relevant previous year is 2021, and for preceding previous year is 1920, 1819, 1718, 1617, 1516, 1415, 1, 2, 3, 4, 5, 6. One more year we can take 13, 14, 7. All right. So the first condition, it says 7, 8, 9, 13, 14, 12, 13, then 11, 12. For the past 10 years, he visits India every year for 100 days. All right. Now, what we are checking is he is a resident in India in the relevant PY. Now we have to check whether he is an ordinary resident or not ordinary resident. And a person is said to be a not ordinary resident only when he satisfies any of these 2 conditions. That's what the Act says. And the first condition, he should be a non-resident in 9 out of 10 preceding previous year to the relevant previous year. That means you take the relevant previous year and check the preceding 10 previous years. In the preceding 10, out of the 10, if he is a non-resident in 9, then he will be a RNOR. That is the first condition. All right. So the preceding 10 has been listed here. All right. So in 1920, in that year, he stayed in India for 60 days. In preceding 4 previous years, his days of stay is 400. So in 1920, he will be a resident. What about 1819? 1819 also he stayed that year for 60 days plus preceding 4 previous year 400 days. So 1819 also he is a resident. All right. So in 1718 also he will be a resident. In 1617 also he will be a resident. So what the first condition states is, if such individual has been a non-resident in India in 9 out of 10 previous years preceding the relevant previous year, then is an RNOR. But here that person is a resident. All right. If you check the preceding previous years in 1920, 18, 19, 16, 17, 16, sorry, 17, 18, 16, 17, 15, 16, etc. He is a resident. So first condition will never get satisfied. Now, moving on to the second condition. If such individual has during 7 previous years preceding the relevant previous year has been in India for a period of 729 days or less. What do you mean by that? You need to take the total number of days of stay in 7 preceding previous years. So 7 preceding previous years means these 7 years. And what is this total number of days of stay? 7 year into 100 days every year, it will be 700 days. If it is less than 729 days, that's what they're saying. Please listen. Condition number 2, if such individual has during 7 previous years preceding the relevant previous year has been in India for a period of 729 days or less, that means out of his 7 preceding previous year, his total number of days of stay in India should be either 729 days or less, for calling him as what? RNOR. So here you see, as you can see, 7 preceding previous year total number of days of stay will be only 700 days. So definitely that second condition is satisfied and he can be called as RNOR. You might have studied the reverse one. Alright. So he can be called as an ROR if he satisfied all the following conditions. So you might have studied that. But let me tell you very frankly, friends, you must study the other one. Study this one. That means 9 out of 10 non-resident for treating him as RNOR, and 729 days or less in the 7 preceding previous year for treating him as RNOR. Why? Because in the February 2020 annual budget, there was a drastic amendment in relation to that residential status. Now for Indian citizens or person of Indian origin who are residing outside India, comes on a visit to India, for that person, if he has income from Indian sources more than 15 lakh, then there's a new determination of residential status now. His relevant previous year days of stay should be 120 days or more. In the preceding 4 previous years, his total number of days of stay is 365 days or more. Currently, he will be treated as a resident. So there is a new condition in the residential status as a part of February 2020 annual budget. So after this new condition, it is better to study who is RNOR rather than studying who is ROR. I hope you are getting my point. Anyways, so in this question, that second condition is definitely satisfied. And Mr. Britley, and what is his final status? So Mr. Britley is anyways a resident, but not ordinary resident. And that is the final verdict of part A. So let's read part B. What is part B? Would your answer change if the above facts are related to Mr. Srinath, an Indian citizen who resides Australia and represents Australian cricket team? Okay. So now in the B part, what they have asked, it is not Britley, it is Srinath. All right, I will call him as SN. And he is currently residing in Australia. And he is an Indian citizen. Hope you remember. All right, there are actually 2 basic conditions: 182 days or more in the relevant PY, days of stay in India, or 60 plus 60 in the relevant PY plus 365 days or more in the preceding 4 PY. So these are the 2 basic conditions for determining whether a person is a resident in India or not. And this second condition is not applicable for certain category of person. Hope you remember. If you are a person, if you are an Indian citizen and you are going out of India for employment purpose, you are an Indian citizen and going out of India for employment purpose, then the 60 plus 365 condition is not applicable for you. The only condition will be 182 days or more condition. And say you are a part of an Indian ship going outside India. say you are a part of an Indian ship, or you can say, you can call yourself as a crew member of an Indian ship, and you are going outside India. In that situation also, the 60 plus 365 condition is not applicable for you. The only condition will be 182 days or more in the relevant previous year for determining residential status. And finally, say you are an Indian citizen or you are an Indian origin who resides outside India, comes on a visit to India. You are coming on a visit to India. If you are in this particular category, then what happens is, then also the 60 plus 365 is not applicable. The condition is 182 days or more in the relevant previous year, but there is an additional condition for this as a part of Feb 2020 annual budget. And what is that additional condition? Say you are an Indian citizen or Indian origin residing outside India, but if you have Indian sources of income or income from Indian sources in the relevant PY, it is more than 15 lakhs. Say in the relevant previous year, if you have income from Indian sources and the income is more than 15 lakh, then for determining your residential status, definitely that 182 days or more condition is there in the relevant PY. Along with that, there is one more condition. If you stayed in India for 120 days or more in the relevant previous year, or in the four, along with that, not or, and in the 4 preceding previous year, if you stayed in India for 365 days or more, in that situation also, you will become a resident in India. Hope you got this point. All right. So now the question is in relation to Mr. Srinath. All right. He comes to India. There is no other difference. If the question instead of Mr. Britley, if the person is Srinath, being an Indian citizen, resides in Australia, comes on a visit to India 100 days every year, what could have been the answer? That's what they asked. All right. Srinath is visiting India for 100 days every year. All right. So Srinath will come under which category? This Indian citizen or Indian origin residing outside India comes on a visit to India category, Srinath will come. So what will happen? The only condition applicable for him to determine residential status is 182 days or more in the relevant previous year. Because in this question, they are not stating that Mr. Srinath has any income from Indian sources. Right? In the question, it is very clear. He's coming to India for some cricket practice or something. All right. So from the question itself, it is very clear. He has no other sources of income from India. So the only condition for taking the residential status is that 182 days or more condition. And hence we can say every year he visits India only for 100 days. So the Srinath will be definitely a non-resident. He's not a resident because 60 plus 365 condition is not applicable for an Indian citizen or a person residing outside India who comes on a visit to India. So definitely he's a non-resident. Moving forward, what if? What if, again, part C, there is one more part is there, part C. What would be your answer if Srinath has visited India for 120 days instead of 100 days every year, including PY 2021? So they're asking, instead of 100 days, if Srinath visited India for 120 days, what would have been your answer? Again, there is no change in answer because our assumption is Srinath does not have any income from Indian sources. So even if he visits 120 days every year, that 120 plus 365 condition is not applicable for him. Why? If this condition is applicable only if Indian sources income of that person is more than 15 lakh in the relevant PY. Here in the question, Srinath's income is not, they are not mentioning Srinath's income. And our assumption is Srinath does not have any income from India. So what is the final verdict? Even if Srinath visits 120 days or more every year, his status would be the same, non-resident. Why? Because for him, the only applicable condition is 182 days or more in the relevant PY. Is that clear, friends? Oh, question number 2 is actually not over. There is one more part in question number 2, right? So question number 2, C is there. I think we have discussed B. Now it is C. So what is question number 2, part C? Ganesh has 3 houses, all of which are self-occupied. The particulars of houses for the previous year 1920 is also given. Compute Ganesh's income from house property in the AY 2021 and suggest which house should be opted by Ganesh to be assessed as a self-occupied so that his tax liability is minimum? Which is actually a very good question. So Ganesh, Mr. Ganesh has 3 house properties. He treats property 1, property 2 and property 3, all of these properties as self-occupied. Now what is your objective? You need to compute out of this 3, only 2 can be treated as self-occupied and 1 is deemed let out. Yes or no? So you need to determine out of this 3, which 2 shall be self-occupied and which one shall be deemed let out. For that, what you have to do? You need to compare with different alternatives, out of which is the best beneficial option for the assessee. So which is the best beneficial option for the assessee? In the option where the tax liability is less, that option will be the best beneficial option for the assessee. Now let's compute. So a question like this, if there is a question like this in your examination, what you need to do? First, you take an assumption. What is that assumption? This is the easiest way to solve this question. The first assumption is assume that all these 3 house properties are deemed let out. All right. First of all, assume that all these 3 house properties are what? Deemed let out. If these 3 house properties are deemed let out, now let's compute what? Let's compute the gross annual value. So computation of gross annual value. House property 1, house property 2, house property 3. All right. How to compute gross annual value? First, you need to compare your fair rent with the municipal value and whichever is higher shall be selected. So fair rent and municipal value, whichever is higher, first alternative, 375 is the higher. Then compare it with the standard rent and whichever is lower shall be selected. So 375 and 350, whichever is lower means what? 350 shall be selected. So this will be the expected rent. In the case of deemed let out property, will there be any actual rent received? Please respond. In the case of a deemed let out property, will there be any actual rent received? No, there won't be any actual rent received, right? So this expected rent will be the gross annual value. And in relation to house property 2, you compare first municipal value and fair rent and whichever is higher shall be selected, that is 360. Compare it with the standard rent and whichever is lower shall be selected. So GAV will be 360 itself. We are doing this based on an assumption. What is the assumption? All these 3 house properties are let out. All right. Now, house property 3, you compare your municipal value and fair rent and whichever is higher, that means 360. Then compare it with the standard rent and whichever is lower shall be selected, that is 375. So expected rents and gross annual value is already determined. So we will write it down. So the GAV of property 1, it is property 1, the GAV is 350, is 350, and property 2 is 360, and property 3 is 375. So these are the GAVs. All right, 350, 360 and 375. Now, is there any municipal taxes paid? There is no information in relation to any municipal tax payments, right? So is there any information in relation to municipal tax payment? Yes. They are stating municipal taxes during the year is 12%, 8% and 6%. So municipal tax 12% is paid based on what value? Based always on the municipal value. Yes or no? Municipal tax is always based on, if it is given as a percentage in your examination, then it is definitely computed on your municipal value itself. So we can compute that municipal taxes paid, first case it is 3 lakh into 12%. So what is 3 lakh into 12%? 3 into 12%, it would be 36,000. And the second case, what is the municipal value? It is 3,60,000 is the municipal value into what is the percentage? It is 8%. So 3,60,000 into 8%, it would be 28,800. And in the third case, municipal value is 3,30,000 and the percentage in the question is 6%. So 3,30,000 into 6%, it would be 19,800. So friends, now let's compute the net annual value, NAV. So in the first case, what is the net annual value? In the first case, net annual value is 350 minus 36 and that will give you 3,14,000 as the net annual value. In the second case, 3,60,000 minus 28,000, it would be 3,31,200 as the net annual value. And the third case, 375 minus 19,800, that would give you 3,55,200 as the net annual value. So these are the net annual values in the question. Now let's compute standard deduction. Let's compute standard deduction. And we are solving this based on an assumption that all the three properties are deemed let out. Okay. Now standard deduction is at 30%. So 30% of 3,14,000 is 94,200. 30% on 331,200 is 99,360. 30% on 355,200 is 1,06,560. So yes. Now there is some interest on loan as well. There is some interest on loan as well. So let's see which all are the interest on loan. So it says interest on money borrowed for repair of property during the current year. So for repair of property during current year is 55,000 in house property 2. So we can take 55,000 as interest on loan in house property 2, and interest on loan for current year for the purchase of property house property 3, there is a 1,75,000 as the interest. 1,75,000 is the interest for house property 3. So now let's compute the income from house property. Income from house property, and how much will be the income from house property? 314 minus 94,200, it would be 2,19,800. 331,200 minus 99,360 minus 55,000, it would be 1,76,840. Now 355,200 minus 1,06,560 minus 1,75,000, it would be 73,640 as well. Now let's do a comparative analysis. All right. Now let's pick the best option. So option 1, I am treating house 1 and house 2 as self-occupied. Then house 3 is deemed let out. So if it is so, then what is the income from net annual value of house property 1? House property 1, the net annual value will be nil. Because if we are treating it as a self-occupied, the net annual value will be 0. And house property 2, the net annual value is 0. But if in the case of a self-occupied property, we can claim interest as a deduction, but there are certain ceiling limits. Hope you remember. For a self-occupied property, if loan is taken for construction or for purchase of property, then up to 2 lakh rupees you can claim as a deduction for interest on loan. If the loan is taken for repair, renovation, expansion, etc., then maximum deduction under 24B is 30,000. Hope you remember that point. So if we are considering house property 2 as a self-occupied property, can you claim this entire interest on loan as a deduction? Respond, friends. Can you claim that entire 55,000 as a deduction? The answer is no, because that loan is taken for the purpose of what? For the purpose of, I think it is for repair, right? Yes, that money is taken for the repair. So the maximum deduction is 30,000. And hence loss from house property would be 30,000. House property 2, if you are taking it as a self-occupied property, loss will be 30,000. That loss is on account of interest on housing loan. All right. And house property 3, we know the profit. We have computed it. That is 73,640 is the profit. So what is the net income? 73,640 minus 30,000, and the net income would be 43,640 rupees in option 1. Now let's take option 2. Option 2. What is option 2? We are treating house property 1 and house property 3 as self-occupied. So house property 2 will be deemed let out. All right. If house property 1, the income would be anyways nil, because we don't have any deductions or nothing from that. Then from house property 3, there is an interest. All right. There is an interest limit. And what is that interest amount? It is 1,75,000 is the actual interest, right? 1,75,000 is the actual interest, and it has been taken, the loan has been taken for what? For purchase of house property. So the loan has been taken for the purchase of house property, and this is the current year interest. So up to 2 lakh you can claim it as a deduction. So tell me, friends, what is the impact? Can you claim this entire 1,75,000 as a deduction? Please respond. Can you take this entire 1,75,000 as a deduction? Yes. Up to 2 lakh you can claim it as a deduction. All right. So what you can do, 1,75,000 is the loss from house property. And house property you know the profit. It is 176,840. 176,840 is the income. So what will be the net income amount? 176,840 minus 175,000. It would be 1,840 as the income. That is the income, net income. Then option 3. What is option 3? You will treat house property 2 and house property 3 as self-occupied. House property 1 deemed let out. So let's take that option. So house property 1, you know the income. What is house property 1 income? We have already computed 219,800. So house property 1 income 219,800. House property 2, you can claim a maximum deduction. If house property 2 is self-occupied, then maximum deduction up to 30,000 is the loss. And house property 3, if it is self-occupied, then up to 1,75,000 loss, you can claim it as a deduction. So what will be the net income? 219,800 minus 30,000 minus 1,75,000, and it would be 14,800 will be the net income. All right. Then there is one more thing. It is not 14,800. Hope you remember. If you have 2 self-occupied house property and there is another overall ceiling limit for interest deduction. Hope you remember that. And what is that? Say house property 2 is self-occupied and house property 3 is also self-occupied. If you can maximum claim only 2 lakh as what? As deduction under 24B. There is an overall ceiling limit. If you consider both the house property and taking that interest, that overall interest shall in no case exceed 2 lakh rupees. There is a condition like that also. So what happens is, this 30,000 and 1,75,000, if you total it, it will be 2,05,000. But can you claim this entire 2,05,000 as a deduction under 24B? No. The maximum deduction is only 2 lakhs. So what will be the net income, friends? It will be 19,800. So tell me which is the best option out of this 3. Option number 2 is the best option out of this 3 because your net income is only 1,840. And that should be the final. Okay, friends, now it is question number 3A. We will solve question number 3A first. Thereafter, we will move on to the remaining questions. Okay, question number 3A, it states that Mr. Vasudev is an officer in a company in Jaipur. He furnished the following particulars regarding his income for the previous year 2021. So it is basic salary, bonus, DNS allowance, etc. is there. All right, now what you are supposed to do? Compute his taxable income from salary for assessment year 21-22. Assume that population of Jaipur is 26 lakhs as per 2001 census. All right. So what you are supposed to do? You are supposed to compute his taxable income from the head salary for AY 21-22. All right. So let's write a heading and move forward. Computation of salary income. All right. So computation of salary income. Okay. So yes, we'll start with the first element. Basic salary 17,000 per month. So what you're supposed to do, take that 17,000 into 12 months. So we can take that basic salary 17,000 into 12, and what would be the sum? It is 2,04,000 rupees. Now let's move on to take the next item. It is bonus 5,000. It's not stating 5,000 per month. They are only saying it as 5,000. That means it is yearly bonus is rupees 5,000. Don't take 5,000 into 12 because the question, it's very clear. They are only saying 5,000. That means yearly bonus is only 5,000 rupees. So bonus rupees 5,000 straight away given in the question. Now moving with the next item is the DNS allowance, DA, that is 3,000 per month. So DNS allowance is 3,000 into 12 months. And how much will be the DA? It is 36,000. Now, moving forward with the next item is traveling allowance 45,000, and he spends around 30,000 for official purpose. Now tell me, friends, can you claim any exemption or a deduction for traveling allowance received? Please respond. Is there any exemption or deduction for traveling allowance received right now? The answer is no. Currently, there is no exemption or no deduction for traveling allowance received. If you have received any traveling allowance, whether you spend it or not, that entire traveling allowance will be taxable. But there is one thing. In this question, what they are saying, you have spent around 30,000 for official purpose. Yes or no? Out of this traveling allowance, you have spent around 30,000 for official purpose. So that 30,000 is just like you have expended something and you got a reimbursement. Yes or no, friends? Please respond. That 30,000 is just like you spend some amount and you got it as a reimbursement and the company is calling it as traveling allowance. Yes or no? So that is not your benefit. You're not getting any benefit for that 30,000 rupees. You're not getting any benefit because you spend something for your traveling for official purpose and the company has given you that amount 30,000. All right. So you cannot treat that 30,000 as your what salary. But that 45,000, you got 30,000 as reimbursement. The rest, the difference of 15,000 will be definitely a benefit, will be taxable as salary as well. All right. So the total traveling allowance received is 45,000. Out of this, 30,000 is just like a reimbursement for traveling expenses you have incurred for official purpose. And hence only 15,000 will be the benefit received by you, and that only will be taxable under the head salaries. Hope you can follow. Again, friends, moving forward with point number 5, it is reimbursement of medical bills 15,000. Treatment was done in government hospital in India. So tell me, friends, government hospital, you have incurred some medical expenditure from a government hospital. All right. Do we have to treat that amount as your taxable salary? Please respond. Do we have to consider it as your taxable salary? The answer is no. No. If you have received any medical treatment, all right, you have expended any medical treatment, that is obviously a personal benefit and your employer is giving you that payment. But if you have incurred that medical expenditure from a government hospital, then under section 10, income tax specifically exempts that particular benefit received by you. So this 15,000 is not taxable. So you can write a note like this. What should be the note? That 15,000 being medical expenditure incurred in a government hospital and hence fully exempted. That's what you can write. All right. So we are not considering that particular medical expenditure of 15,000. It is fully exempted. Now, moving forward with the next item is he lived in a bungalow belonging to the company. Its fair rent is 15,000 per month. That bungalow's fair rent is 15,000 per month. The company has provided on this bungalow the facility of a watchman and a cook, of each of whom is being paid a salary of 250 per month. So the cook and watchman is getting a salary of 250 per month as well. The company paid in respect of this bungalow rupees 4,500 for electric bills and 33,500 for water bills. It's a long story. All right. Now, friends, he lived in a bungalow belonging to the company and its fair rent is also given. All right. So let's start solving this. First of all, he's getting a rent-free accommodation. Yes or no? In this case, he's getting a rent-free accommodation. So that value of rent-free accommodation have to be considered as a perquisite taxable in the hands of employee. All right. So the value of rent-free accommodation we have to find out. So value of rent-free accommodation. We need to value that rent-free accommodation first. Now, how to value rent-free accommodation? Hope you remember. So what we were discussing is value of rent-free accommodation. All right. How to value rent-free accommodation, friends? If that property is taken on lease by if a property owned by the employer has given to the employee as a rent-free accommodation, then how to value the property? Hope you remember. It is 15% of the salary if the population of the city is more than 25 lakhs. So what is the population of this particular city where he resides? It is given in the question. Assume that the population of Jaipur is 26 lakhs. So the population of the city where he has been given with a rent-free accommodation is around how much? It is 26 lakhs. So how much is his taxable rent-free accommodation? It is 15% of his salary. And what do you mean by salary here? And there is a definition for salary under rent-free accommodation. And what is the definition? Let's go through the definition of salary under rent-free accommodation. Please listen. Salary for the purpose of rent-free accommodation means it includes pay, allowances, bonus, commission payable monthly or otherwise, or any monetary payment by whatever name called from one or more employers as the case may be. However, it does not includes the following. From the salary definition, you are not supposed to include the following. Number one, DA, unless it enters into computation of superannuation or retirement benefit of employee. So under salary for the purpose of rent-free accommodation, you are supposed to consider DNS allowance only if it forms part of retirement benefit. Then number two, you are not supposed to consider employer's contribution to provident fund. You are not supposed to consider any employer's contribution to provident fund. Then allowances which are exempted from tax also you must not consider as salary for the purpose of RSA. Now, value of perquisites specified under 17.2. If there is any perquisite value received by you, that is also not considered as salary for the purpose of computing rent-free accommodation. And point number 5, any payment or expenditure specifically excluded under proviso to section 17.2, that is payment of medical insurance premium specified therein. So what do you mean by that? Any amount or a payment specifically excluded under proviso to section 17.2, that is payment of medical insurance premium specified therein. Say for example, any medical insurance premium you have paid, that should not be treated as what? Salary definition for the purpose of rent-free accommodation. Now friends, let's compute the salary for rent-free accommodation. So we will write a separate note for that. Note, computation of salary for rent-free accommodation. We need to take basic salary, no doubt for that. We should consider basic salary of 2,04,000. Now, we must consider bonus as well. So bonus, what is the bonus amount? What was the bonus amount? Bonus amount from the question was 5,000. 5,000 rupees was the bonus amount. Now, is there anything else that you have to consider? Yes. Except perquisites and other thing, you must consider every other thing as what? As a salary. So let's see which all are the other things in relation to that. There is DNS allowance. In relation to DNS allowance, they are not stating whether it forms part of retirement benefit or not. They are only saying DNS allowance. So our assumption is DA does not form part of our retirement benefit. So in this question, what we are doing, we are taking an assumption stating that, and the assumption is DA does not form part of what? Retirement benefits. Now, traveling allowance, it is an allowance, right? Traveling allowance out of 45,000, 30,000 is just like a reimbursement. So the remaining 15 is there. So that 15,000 also you have to consider. DA 15,000 you have to consider. Now, what is the next element? The next is in relation to rent-free accommodation, then watchman, cook, electricity bill, water bill, etc. are perquisites. Watchman, cook, electricity bill, water bill, etc. is payable by employer is actually perquisites taxable under section 17. If there is any perquisites for computing rent-free accommodation salary, you are not supposed to include that perquisite element. So perquisites are not actually considered for salary while computing RFA, rent-free accommodation. Now, next is in relation to car. The car given is also definitely what? A perquisite given by the employer to the employee. So that also should not come under rent-free accommodation definition. Then it is in relation to contribution to PF. So the definition clearly states that if there is some contribution to PF, etc., that also should not form part of salary for the purpose of rent-free accommodation. Then is there anything else we must take? Rent recovered. All right. So these are the items that can be considered as salary for the purpose of rent-free accommodation. So what is the total amount of salary? 2,04,000 plus 5,000 plus 15,000, it would be 224. 224 lakh is the salary for the purpose of rent-free accommodation. Now, being the population of the city is more than 25 lakhs, what you must take? You must take 15% of this 2,24,000 as what? As your rent-free accommodations perquisite element. So 2,24,000 into 15%, it would be, sorry, 2,24,000 into 15%, it would be 33,600. That is the value of rent-free accommodation. Now let's go back to the main computation sheet. Rent-free accommodation, value of rent-free accommodation is 15% of salary. It would be 33,600. Now, in the act, it is very clear. If there is any amount recovered from the employee, that amount shall be reduced while computing rent-free accommodation. Yes or no? If there is any recoveries from the employee, you need to deduct that amount. So there is recovery from the employee. At the end of the question, they are saying rent of house recovered from Vasudev. That means the employee is 21,600. So there is a recovery, and that amount recovered, 21,600, is definitely deductible from the value of RFA. And hence, what is the taxable value of RFA? 33,600 minus 21,600, it would be only 12,000 rupees will be the taxable rent-free accommodation. I hope that is also clear. Moving forward, we completed the rent-free accommodation, and there are certain other things. Facility of watchman and cook, and both are receiving 250 per month. That is also perquisite. All right. So we can write watchman as perquisite. Provision of watchman is 250 per month into 12 months. And 250 into 12 months, that is 3,000 rupees he is getting as a perquisite. Now cook. For cook also there is a perquisite element, 250 per month into 12 months. So that is also 3,000 rupees. So for cook and watchman, he is getting a benefit. Now, then is there anything else? There is some reimbursement of electricity and water charges. Yes or no? The company in respect of this bungalow, rupees 4,000 for electric bills and 3,500 for water bills. So tell me, friends, what is the treatment of that electric bills and water bills? That is also perquisite, right? So that electric bills, I will write EB. Electric bills, what is the amount? The company is paying electric bills of 4,500. That is also definitely perquisites. And water bills, I will write WB. And what is the amount of water bill the company is paying? It is 3,500. So 3,500 is paid as water bills as well. So all of these are perquisites. Now, moving forward, adjustment number 7, it has been provided a 1.5 liter engine capacity. If it has been provided with a car with a 1.5 liter engine capacity for official and personal purpose, the maintenance and running expenses of the car, including driver, are borne by the company. All right. So it has been provided. So we can say, again, we will write a working note. Car owned by employer and maintenance and running charges are met by employer. So car is owned by employer and maintenance and running charges are also met by the employer, and car is used for official as well as personal purpose. Now friends, tell me how to compute perquisite value if the car is, what is the cubic capacity of the car given in the question? The cubic capacity of the car is 1.5 liter. So it is a 1.5 liter car. All right. So the CC is less than 1,600. Now friends, tell me what is the, how to compute perquisite value. As per the act, for the car, you take 1,800 rupees per month as a statutory value for computing perquisite. If driver is also provided, then additional 900 rupees per month have to be considered as a statutory value for valuing perquisite. Hope you remember. there are certain statutory values. If the car is owned by that particular employer, and maintenance and running charges are also met by the employer, then we must consider these statutory values for computing perquisites. So how to compute perquisites? Whether there is a driver or not, we have to check. So it has been provided with 1.5 liter engine capacity for official and personal use, and the maintenance and running expense of the car, including driver, are borne by the company. So how to value perquisite? It is based on the statutory value of 1800 plus 900 into 12 months will be the value of car provided, or the perquisite value taxable in the hands of employee, and that would be 32,400 will be the value of perquisite, right? So you can consider perk valuation of car, it is 32,400. All right, now let's move on. Let's move on, friends. Moving on to the next one. The following amounts were deposited in Provident Fund on contribution 24,000 and company's contribution 30,000. Interest is at 12%, that is 12,600. So hope you remember, in income tax, if you are contributing, if the employee both are contributing to recognize the Provident Fund, if they are contributing to recognize the Provident Fund, hope you remember, there are certain specialities. What are the specialities? Employees on contribution to recognize Provident Fund is not a perquisite. Why? From my income, I am contributing to recognize the Provident Fund. Do I have to consider that contribution as a perquisite or as a taxable salary? No, because from my own contribution is never a benefit for me. I'm contributing it from my own pocket, right? But for the employer portion, if the employer is contributing something to a recognized Provident Fund on behalf of employee, then that will be definitely a taxable item in the hands of employee. Yes or no? So that we have to consider first. Employer contribution to Provident Fund. Recognize the Provident Fund, I'll write. So what is the employer contribution to recognize Provident Fund? It says 30,000. In income tax, there is an exemption. And what is an exemption? Up to 12% of salary is allowed as a deduction. Only the excess, if the employer is contributing over and above 12% of the salary, then that only will be taxable as what? A salary in the hands of employee. All right. So up to 12% of salary, you can claim it as a deduction. And what is the definition of salary here for computing that exemption? It's very simple, friends. We will write a working note for that. Salary there means basic salary plus DA if forms part of a retirement benefit plus commission if it is expressed as a fixed percentage of turnover. Hope you remember the salary definition there. Salary for the purpose of recognized Provident Fund exemption is basic salary plus DA if forms part of a retirement benefit plus commission if it is expressed as a fixed percentage of your turnover. Now tell me, friends, what is the basic salary in this question? 2,04,000. What is the DA? DA is there, but they are not stating that it forms part of retirement benefit. So we are assuming that DA is not forming part of retirement benefit. Now, friends, is there any commission in the question? Is there any commission in the question? There is no commission element in the question. It is actually silent, and so we are not taking any commission as well. So the salary for this purpose is only 2,04,000. So let's go back to the main sheet. 2,04,000 into 12%, you can take it as a deduction. So 2,04,000 into 12%, it would be 24,480. Only the remaining amount. Sorry. That is actually, this is not the main sheet. This is our computation only, right? I think this is the main sheet. Yeah, this is the main sheet. So 2,04,000 into 12%, it would be 24,480. That will be the exemption. So the net amount is 5,520 rupees. That will be the taxable employer contribution under the head salaries. Now, what about interest? What about interest, friends? Let's go back to the question. interest at the rate 12% per annum is 12,600. So in income tax, interest up to 9.5% is exempted. If there is interest over and above 9.5% in the recognized provident fund, only that interest will be taxable as salary. All right. So what you can do, that interest portion, total interest portion is around 12,600. That is 12% interest. So 12,600 by 12% into 9.5% will be the exemption you can claim. 12,600 divided by 12% means the amount on which interest is acquired. Into 9.5% will give you the amount of exemption that you can claim out of the total interest. So that is 9,975. That you can definitely claim as an exemption, and 12,600 minus 9,975 will give you 2,625 as taxable interest. Right? Now, moving forward, I think by that there is no more further adjustment, right? So that all are the only adjustments we have. Now let's compute the gross salary. So let's compute the gross salary, friends. 2,04,000 plus 5,000 plus 36,000 plus 15,000 plus 12,000 plus 3,000 plus again 3,000 plus 4,500 plus 3,500 plus 32,400 plus 5,520 plus 2,625 will give you 3,26,545 rupees as the gross salary. So 3,26,545 rupees is the gross salary. I have taken a computation. I have totaled it. All right. Now it is the standard deduction. Standard deduction is there. That is rupees 50,000. That you can claim. All right. So minus 50,000 will give you 2,76,545 rupees as the taxable salary. So, and that is the final answer to the question. Moving forward, friends, the next question, it is B. There is a B. 3B is there. So what is 3B? State with brief reasons whether the following are agricultural income, either in whole or in part. So it is actually an easy question. You must say whether the following is agricultural income or not. It is as simple as that. First one, purchase of standing sugar crop by Mr. Aman for 2 lakh, and after cutting the canes, selling them for 2 lakh 40. So he is purchasing sugar crop and he is doing some processing and sell it for some amount. So is there any basic operations or subsequent operations done by that particular person, by Mr. Aman? No. It is a trading. He purchases sugarcane crop, processes it and selling it. All right. So that cannot be called as what? Agricultural income. So the first answer, it is not an agricultural income. Why? Because no basic operations or no subsequent operations is done in land. For calling as an agricultural income, you must do some basic operations and some subsequent operations. Yes or no? Here, the basic operations and subsequent operations are missing. So not an agricultural income. Then point number 2, income from milk dairy runs by Mr. Rajesh in his agriculture land 50,000. So Rajesh has some agriculture land and he runs a milk dairy. That means he is selling milks. It's a dairy farm. Can you call it as a agricultural income? Please respond. Can you call that item as an agricultural income? No. Because a dairy farm is not, done as a part of any basic operation or subsequent operation in the land. Dairy farm is actually, it is what? Income from your cattle. Maybe cow, goat, buffalo, etc. All right. So you cannot call that particular milk as an agricultural income. And again, the answer is not an agricultural income, because again, basic operation and subsequent operation from land is missing. Now, moving on to the third item, income from sale of plants 10 lakh earned by Mr. Jain, who maintains a nursery by name Prakriti Nursery. So it is actually from nursery, and that person might be selling plants for 10 lakh. So is that agricultural income? Definitely it is agricultural income. Why? Because nursery means what? You are growing some plants in the land. So when the plants is ready, you will cut that and sell it for a price. So definitely there is basic operations are there, and there are subsequent operations as well, and definitely we can say that is agricultural income. So the answer is yes, because there is basic operation. Again, conversion of sugarcane into gur. All right, if you are converting sugarcane into gur, then you tell me whether can you treat it as an agricultural activity? No, it is a manufacturing. You are converting sugarcane to gur. So if you are converting sugarcane into gur, then as you know what happens, it cannot be treated as what? An agricultural income. It is only manufacturing process, so not an agricultural activity. Again, item number 5, income from sale of rubber, 3,20,000 realized by Mr. Ram Nair, who owns rubber estate and cultivates rubber. So Mr. Ram Nair has some rubber estate and he cultivates rubber. So as you can see, that if you are in the business of rubber, then you will treat all the profits from that activity as what? A combined profits. Hope you remember there is a rule, right? So according to the income tax rule, what you need to do, 65% of that income will be treated as agricultural income and the remaining 35% will be treated as business income. So what should be the answer? Out of this 3,20,000 total income, out of this 3,20,000 total income, 65% is agricultural income. And what is 65% of agricultural income? That is 2,08,000 will be agricultural income. And the remaining will be, that means 112 or 1,12,000 will be business income. Hope you remember. It is under Rule 7, Rule 7, 7A and Rule 8 is there. Tea growing and manufacturing, rubber growing and manufacturing, coffee growing and manufacturing. If it is tea growing and manufacturing, then the split is 60-40. 60% agricultural income, 40% business income. If it is the rubber growing and manufacturing, it is 65-35. 65% will be the agricultural income, 35% will be business income. If it is coffee growing and manufacturing, it is also 75-25. And if there is roasting and grounding of coffee, then it is 60-40. Hope you remember that. All right. Now, I think there is one more. There is one more income. Income from grazing of cattle allowed in land owned by Mr. Richard, and it is 70,000 rupees. So again, you are grazing cattle. Cattle means, say for example, maybe goat or maybe cow. All right. There is no basic operation from land. So that 70,000 also cannot be called as an agricultural income. It is not an agricultural income because basic operation not there. Basic operation is missing. So you cannot call it as agricultural income as well. All right, friends. So let's move forward. So moving on to the next question, that is question number 4. It is 4A. Y submits you the following particulars. All right, there are certain particulars submitted by Mr. Y, and you need to answer that question based on these particulars. So there is urban agriculture land, rural agriculture land, listed shares are there, then gold is there, residential house property is there. Then it says he deposited a sum of 4 lakh on 25/6/2021 in capital gains scheme as he intended to buy an agricultural land later. Then out of the sale proceeds of gold, he invested 1,96,000 on purchase of residential house property on 15/5/2021, and the shares were sold through recognized stock exchange. Therefore, STT was paid. FMV of these shares as on 31st January 2018 was 75,000. So what you are supposed to do? Compute taxable capital gain for assessment year 21-22, and there are certain cost inflation indices are given. Cost inflation index numbers are given. 2001-2, 2002-3, 1920, 2021 numbers are given. 100, 105, 289, 301 respectively. So we are supposed to compute the capital gain impact. All right. So let's compute it together. So the first asset, which is the first asset here given in the question, it is urban agricultural land. So friends, can you call urban agricultural land as a capital asset? The answer is yes. Urban agricultural land is definitely capital asset, but if that agricultural land is a rural agricultural land, you cannot call it as what? You cannot call it as a capital asset. So rural agricultural lands are not capital assets, and urban agricultural lands are definitely what? Capital assets. So we'll start from that. So urban agri land, it is capital asset. So from the question, let's compute the whereabouts. So sales price is given 15 lakh. So the full value consideration in the question is what? 15 lakh. Full value consideration is 15 lakh. Now, is there any expenditure on transfers? No, they are not stating about any expenditure on transfers. Date on sale is given. Date of sale is given. Then that is purchase. Date of acquisition is 3/5/1978. So this property is purchased on or before 1st April 2001. If a particular property is purchased on or before 1st April 2001, then what is the speciality? While computing the cost of acquisition, either you can take the actual cost of acquisition or the fair market value as on 1st April 2001, whichever is beneficial for the assessee. Hope you remember that point. So in this question, what is the actual cost of acquisition? Is only 50,000. But what is the fair market value of that property as on 1st April 2001? It is 4,25,000. So whichever is higher definitely can be considered as what? Can be considered as the cost of acquisition. So cost of acquisition 4,25,000 rupees. Now you can claim the benefit of indexation as well. Being a long-term capital asset, you can claim the benefit of indexation. So friends, this is an urban agricultural land. How to determine whether it is a long-term or short-term? Based on period of holding. If the period of holding is more than 24 months, then land or a building will be definitely long-term capital asset. If the period of holding is less than 24 months, then it will be a short-term capital asset. Here definitely, as you know, the period of holding is much more than 24 months. So 425 into cost inflation index in the year of transfer. Year of transfer in the question is 2021. And the cost inflation index in the year 2021 is given, it is 301. All right. So we will take into 301 divided by cost inflation index in the year of purchase. As the cost inflation table starts from 2001 to onwards, you can maximum take that 100. Because 1978 is the year of purchase. That year, cost inflation indices are not available. So you can start using that 100 rupees. All right. From the year 2001 to onwards. So what will be the indexed cost of acquisition? 425 into 301 divided by 100, it will be 12,79,250 will be the indexed cost of acquisition. So tell me friends, what will be the capital gain? That capital gain would be, long-term capital gain would be 2,20,750. So minus 10 lakh, it would be 220,750. Yes. Now friends, is there any possibility of an exemption? He deposited a sum of 4 lakh on 25/6/2001 in capital gain scheme as he intends to buy an agricultural land later. Hope you remember there is an exemption under 54B. If a particular assessee is selling an urban agricultural land and he is investing it for purchasing a new urban agricultural land or rural agricultural land, that value which he utilizes for the purchase can be claimed as an exemption from the long-term capital gain. Hope you remember that point under 54B. So in this case, definitely assessee can make use of the benefit of 54B. So the amount he deposited is 4 lakh. The amount he deposited is 4 lakh. It is over and above the long-term capital gain. So the maximum exemption under 54B, it shall be 2,20,750. Because under 54B, if the amount which we are utilizing to purchase a new agricultural land, if it is more than the long-term capital gain, then the maximum exemption under 54B will be up to the long-term capital gain. Hope it is clear. So full amount you can claim it as an exemption under 54B and the taxable amount will be nil. All right. So that is for the urban agricultural land. Now moving forward, we will take the next asset, which is the next asset given in the question. So the next asset in the question is rural agricultural land. It is not a capital asset. Rural agriculture land is not a capital asset, so you need to write a note. Rural agriculture land cannot be treated as a capital asset. If that asset is not a capital asset, then transfer, if there is any gain, that is not taxable under where? Under capital gains. For taxing an income under capital gains, there should be a capital asset as well as there should be transfer. All right. So this urban agriculture land, this rural agriculture land is not regarded as a capital asset, and hence on its transfer, even if there is gain, that is not at all taxable under capital gains, and that is over. And moving on to the next asset, that is listed shares. So listed shares, definitely it is a capital asset, and let's compute the long-term let's compute the capital gain. So listed shares. What is the full value consideration of listed shares? It is given as 80,000 rupees. It is given 80,000 rupees is the full value consideration. Then the sale date is 4/6/2020. All right. Now the purchase date is 5/7/2019. That is the purchase date. So for determining whether a listed share is a long term or a short term, the period of holding to consider is 12 months. All right. Now let's check whether it is a long term or short term. 5/7/2019 they purchased and they sold it on 4/6/2020. So it is under 12 months. Yes or no? It is under. The period of holding is less than 12 months, and hence the gain will be what? It will be a short term capital gain. All right. Being a listed share, you are supposed to pay STT as well, security transaction tax as well. So that short term capital gain will be taxable under 111A of income tax. So listed shares, short term capital gain, taxable under section 111A at the rate 15%. So cost of acquisition, we can simply take the cost of acquisition there, and the cost of acquisition given in the question is 60,000 rupees, and hence the short term capital gain would be 20,000. Is there any possibility of exemption or something else? In the question they are stating the fair market value of shares on 1st January 2018 is 75. It is actually not required for our computation because we purchased the share only on 2019. So the fair market value as on 1st April 2018 as well as the fair market value as on 1st April 2001 is also given in the question. These two informations are irrelevant for us. That is only for you to mislead. Right? These are just misleading information, because in examination, if there is something, then what you will think? There will be some confusion will come to you, that's for sure. So these all are just distractors. We can ignore those distractors and we can move forward. So moving on with the gold is the next asset. So next asset being gold. We will write gold here. What is the full value consideration, friends? In the case of gold. So let's check. The full value consideration is 7 lakhs. So 7 lakhs is the full value consideration. So 7 lakh, we will write it as full value consideration. Now, is there any cost of acquisition or direct expenditure? It is sold on 5/2/2021. So 5th February it is sold, and it is purchased on 5/8/2002. It is purchased after 1st April 2001 after. So we can take the actual cost of acquisition 2,05,000. So cost of acquisition 2,05,000. Now let's index it. How to index it? Which is the year of purchase? It is 5/8/2002. That is 2002-2003 is the year of purchase. So 2002-2003, what is the index number? It is 105, and year of sale is 301. So we can make use of the indexation into 301 divided by 105. So 2,05,000 into 301 divided by 105, it would be 5,87,667 rupees as the indexed cost of acquisition for gold. Now friends, what is the long-term capital gain? So long-term capital gain would be 1,12,333. 1,12,333 is the long-term capital gain in that case. But there is one more thing. It is given in the question that out of sale proceeds of gold, he invested rupees 1,96,000 on purchase of residential house property on 15/5/2001. So he transferred gold and purchased or invested that amount in a residential house property, and hence he is eligible to claim an exemption under 54F of Income Tax Act. Hope you remember 54F. You have transferred any asset other than a residential house property, and you are invested that long-term capital gain in purchasing a residential house property, then you are eligible to claim an exemption under 54F. How much is the exemption? So let's compute the exemption under section 54F. So 54F exemption is like this. The quantum of exemption is out of long-term capital gain into amount invested in residential house property, in the new residential house property, divided by net sale consideration. This is what is the quantum of exemption under 54F. So what is this quantum? Out of net sale consideration, how much you have invested in the new residential house property, that proportion on your long-term capital gain will be the exemption. Do you remember 54F? What is 54F? I'll repeat it again. Out of net sale consideration on transfer of your asset, how much you have invested in the new residential house property, that proportion on long-term capital gain will be the exemption under 54F. Now let's compute that proportion. 1,12,333 into what is the amount he invested in the new residential house property? Says he invested 1,96,000, right? He invested around 1,96,000 in the new residential house property. So 1,96,000 divided by net sale consideration. Here there is no direct expenditure on transfer. So the net sale consideration is only that 7 lakh itself. So 7 lakh will be the net sale consideration there. What is the quantum of exemption? 112,333 into 196 divided by 7 lakh. That will give you 31,453 as your exemption. 31,453 rupees as your exemption. So what is the remaining taxable LTCG? 112,333 minus 31,453, it would be 80,880, your taxable long-term capital gain. I hope that is clear. All right, that is in relation to gold. Now, after completing the question, I will come to your doubts, okay? Yes, so the next asset is residential house property. So we will write residential house property. Now, what is the full value consideration for that residential house property? It is given 70 lakhs. Now, there is no direct expenditure on transfer given in the question. It is transferred on 25th February. Now, it is purchased on 8/7/1964. So, it is before 1st April 2001. All right. So, if an asset is purchased before 1st April 2001, then how to take the cost of acquisition? Either the actual cost of acquisition or fair market value as on 1st April 2001, whichever is higher. So here the fair market value as on 1st April 2001 is 25 lakhs. So cost of acquisition, we will take it as 25 lakhs. Now let's index that divided by 100 into 301. So 25 lakhs divided by 100 into 301 would give you 75 lakh 25,000 as the indexed cost of acquisition. Now, what is the long-term capital loss? Here there will be loss, that is 5 lakh 25,000 is the long-term capital loss which you can claim from this. So that is the final answer. So all the capital gains we have computed. All right. So what is question 4B? Compute deduction under 80EEA in the following cases. So you are supposed to compute 80EEA deduction in the following cases. So assessee A, B, C, D, E, F, date of sanction of loan is given, amount of loan is given, stamp duty value of the property is given, other residential property owned by the assessee as on that date is given, then interest for previous year is also given. So before reading this question itself, let's understand what is 80EEA. All right. So 80EEA, friends, there are certain conditions for claiming deduction under 80EEA. First of all, what is 80EEA? Say for example, if you are a first home buyer in India and you have taken a loan for purchasing your house, all right, then interest on loan, if there is interest on loan, then that interest is allowable as a deduction under 80EEA. But there are certain conditions and there are certain other regulations which you need to know. So let's understand which all are the conditions for claiming a deduction under 80EEA. As you can see it from here, the stamp duty value of the house which you are purchasing should be less than or equal to 45 lakhs. This is the first condition. If you want to claim deduction under 80EEA, then the stamp duty value of the house which you are purchasing should be less than or equal to 45 lakhs. Then condition number 2, the loan should be sanctioned by the financial institution during the period between 1st April 2019 to 31st March 2021. And friends, for your information, in February 2021 annual budget, this time limit has again extended to 31st March 2022. All right. So the point it says the loan should be sanctioned between 1st April 2019 and 31st March 2022 as per the latest amended law. And condition number 3, the individual should not be eligible to claim deduction under 80EE. That individual, the same individual, should not claim deduction under 80EE. 80EE also provides for deduction on interest on loan for the purchase of house property. So you cannot claim at the same time for the same interest. You cannot claim deduction under 80EE and 80EEA. All right, forget about 80EE. Our only concern is 80EEA because currently 80EE is not active in Income Tax Act. Again, moving forward, the individual should not own any residential house on date of sanction on loan. So on the date of sanction of loan, that particular individual, if he wants to claim a deduction under 80EEA, should not own any other residential house in India. So these are the 4 conditions for claiming an exemption under 80EEA. Now friends, what is the quantum of deduction here? So the quantum of deduction shall be rupees 1,50,000. All right, the maximum amount of deduction under 80EEA is rupees 1,50,000 rupees. So friends, let's have an analysis before moving on to that particular question. Say for example, I've taken a loan for purchase of house property. Say the interest which I'm paying in a year is 4 lakh. And it is a self-occupied property as well. So the interest which I've suffered by me is rupees 4 lakh. So tell me friends, what is the maximum amount of interest I can claim as a deduction under 24B? Under 24B, maximum amount of interest is 2 lakh. All right, under 24B, while claiming what? While claiming house property income, you can treat that particular house property as your self-occupied property and you can claim a maximum of 2 lakh rupees as a deduction. Over and above 2 lakh, if there is interest liability or interest amount is over and above 2 lakh, then assessee is also satisfying the conditions under 80EEA, then he can claim another further deduction up to 1,50,000 under 80EE. So the point is, if your actual interest liability is more than 2 lakh, only that amount which is over and above 2 lakh will be subjected to claimed under 80EE. You got it or not? So if my actual interest is 4 lakh, out of this 4 lakh, the first 2 lakh I can claim it as a deduction under 24B. Then the remaining, out of the remaining, the other 1,50,000 I can claim it as a deduction under 80EEA as well. All right. Now let's start solving this particular question. Now let's move on to the question. So as you know, the date of sanction of loan, we will take case 1 first. The date of sanction of loan is on 1/10/2020. So it is within 1st April 2019 to 31st March 2022. It is within that period. Amount of loan is 30 lakh. Stamp duty value less than 45 lakh. There is no other residential property in the name of Mr. A. And the interest for the previous year is only 2,20,000. So the interest liability is only 2,20,000. Now the question, how much you can claim it as a deduction? So if the interest amount is only 2,20,000, then up to 2 lakh rupees, you can claim it as a deduction under section 24B while computing house property income. Over and above 2 lakh, all right, over and above 2 lakh, you can claim it as a deduction under which section? Under 80EEA. Is that clear, friends? Please respond. Over and above 2 lakh, you can claim as a deduction under 80EEA. So the remaining 20,000 rupees, you can claim it as a deduction under section 80EEA. So in the first case, the interest liability is 2,20,000 and that is the answer. And friends, there is a correction in the answer sheet. I will distribute this answer sheet with you, but there is a correction in the answer sheet. It shows 70,000 rupees as a deduction in the first case. It is not 70,000, it is actually 20,000. So 20,000 is the deduction in the first case. So if you, while after getting this particular document, make sure that deduction under 80EEA should be what? It should be 20,000 rupees, not 70,000. I hope it is clear. Moving forward, friends, with the next case, case number B. So let's understand the case number B. Say case number B, loan sanctioned between 1st April 2019 to 31st March 2022. Yes. Amount of loan 30 lakh. Stamp duty value of the house is 55. So can you claim 80EEA deduction? The answer is no. You cannot claim 80EEA deduction because the stamp duty value of the house, if you want to claim deduction under 80EEA, then the stamp duty value of the house be how much? It should be less than or equal to 45 lakhs. All right. So he does not have any other residential house property. Interest of 1,20,000. So here you can write that 1,20,000 rupees can be claimed as a deduction under 24B. And under 80EEA, there is no deduction. Deduction is nil. All right. Again, moving forward with the case C, it is 1/10/2020. So within the period, amount of loan is given 40 lakh. Stamp duty value exactly 45 lakh. Exactly 45 lakh, not a problem. You can claim deduction under 80EEA. All right. There is no other residential house property and the interest is 1,20,000. If the interest is only 1,20,000, current year interest is only 1,20,000, then that entire 1,20,000 is eligible to be claimed as a deduction under 24B. That's it. Because 80EEA deduction in that case is also nil. Why? Because over and above 2 lakh interest only will be deductible under 80EEA. Here the actual interest is only 1,20,000. So you can claim that entire 1,20,000 as a deduction under 24B itself. All right. So there is no deduction under 80EEA. Even though that assessee is eligible to claim deduction under 80EEA, his actual interest is less than 2 lakh. Yes. If his actual interest is more than 2 lakh, over and above 2 lakh can be claimed under 80EEA. That is the condition. So moving on to case number D. Date of sanction of loan is on 1st October 2020. Again, within that period. Amount of loan 30 lakh. Stamp duty value 35. But he has other residential house property on date of sanction of loan. So under 80EEA, if you want to claim it as a deduction, interest as a deduction, the major condition, one of the major conditions is that on the date of sanctioning of loan, you should not own any other house property. So the answer is here, that person is owning another residential house property on date of sanction of loan. So he's not eligible to claim 80EEA deduction. This entire 1,20,000, he can claim it as a deduction under 24B. 80EEA not available, nil. Now, moving on to option E, the date of sanction of loan is on 1/10/2018. For claiming 80EEA deduction, what should be the date of sanction of loan? It should be between 1st April 2019 to 31st March 2022. And hence we can say in that case also 80EEA deduction is not available. Interest amount is only 1 lakh. So that entire 1 lakh you can claim it as a deduction under 24B. That's it. 80EEA not applicable. Moving forward with the last case, 1/10/2020 is the date of sanction of loan. Amount of loan 20 lakh. Stamp duty value of the property is 35 lakhs. Yes, there is no other property for him. The maximum interest is 1,20,000. So tell me friends, maximum interest 1,20,000. Hence again, 80EEA deduction is not available because this entire 1,20,000 rupees, you can claim it as a deduction under 24B. So in that case also 80 EEA deduction is not applicable. So I think that is clear for you. Now let's discuss the next question, that is 5A. So the next question is question number 5A. So find the gross total income of Mr. Inter Kumar Basu on basis of the following particulars. All right. Extract of profit and loss account is given in the question. Then interest is there, repairs is there, insurance is there, depreciation is there, compensation is there, net profit is there. So for the time being, I'm leaving that particular extract of P&L account. We will focus on the additional adjustments first. All right. So what all are the additional adjustments? The following adjustments were either credited or debited to the P&L account, and the amount not debited to the P&L account is also given. So what you are supposed to do, you are supposed to compute his gross total income. Or no? So let's compute his gross total income. Since the P&L is given, so it is very obvious that he has a business or a profession. All right. So what we will do, we will write a detailed note for the computation. So computation of gross total income. Computation of gross total income. So computation of gross total income, under that we will first write profits or gains from business or profession. We will start from the PGBP always. All right. So starting point, what is the first starting point? That is the net profit as per P&L account. So friends, what is the net profit as per P&L account? Let's see. In the question, it is very clear. The net profit as per P&L account is 1,30,000. So we will start from the 1,30,000 itself. So 1,30,000 is the net profit as per P&L account. Now we will focus on the each adjustments. Then we will discuss further. So starting with the first adjustment in the question, it says interest includes 200 rupees on loan taken for purchasing debentures of a company and 300 rupees on loan taken for reconstruction of house property let out. So they are talking about two set of interest on loans. Number one, interest includes 200 rupees taken for the purchase of debentures of the company and 300 on loan taken for reconstruction of house property. So friends, tell me, is that interest 200 and 300 related to your business? Definitely not. The first interest is in relation to purchase of debentures. That is an investment activity, not your business activity. Yes or no? So if you have income from debentures, then definitely that 200 can be deductible from the income from debentures under IFOS head, not under PGBP. So what we are doing is we are adding back interest on loan for purchase of debentures. The amount is 200. At the same time, we are also adding back interest on loan for reconstruction of house property, and the amount is 300. Or no? So we are adding back both the 200 and the 300 rupees. Now from this itself, it is very evident you have some debenture interest is there. So if you can go to that particular P&L account credit side, you can see interest on debentures of an institution is there. Gross amount is 10,000. Now the question is whether this 10,000 is taxable under PGBP. The answer is no. That is interest from debentures. Interest income from debentures is taxable under where? It is under income from other source, IFOS. So what we can do? We have to less it from the net profit, because since it is shown as a part of your credit items in the P&L, that 10,000 will be definitely included in the net profit as well. And it is not taxable under PGBP, it will be taxable under IFOS. And hence we need to adjust that 10,000. So less interest on debentures, 10,000 rupees, we have to deduct it from here. Then we need to add income from other source, interest on debentures, and the amount is 10,000 rupees. From that, definitely you can claim interest on loan for debenture purchase. Debenture purchase, and the amount is, what's that amount? I think it is 200 rupees, right? It is 200. Yes, you can less it from here. All right, now let's move on to the P&L account again, because they were mentioning about some house property interest incomes. Sorry, house property interest expense. Now there is another credit in the P&L account, that is rent from house property. Now the question whether this rent from house property is taxable under PGBP? No. That rent from house property is definitely taxable under income from house property head. All right. So what you need to do? You need to less it from the net profit and you need to add it up with the house property income. So that 36,000 have to be deducted from the PGBP. Rent from house property 36,000, we have to deduct it from here and we need to add it up under income from house property. Rental income 36,000 rupees. And there is one more expense, you know that 24B, there is an interest on loan for reconstruction of house property. Reconstruction of house property, it is there 300 rupees, because it is there given in the question. So it is done as a part of the first adjustment itself, because rupees 300 on loan for reconstruction of house property is given. So that 300 definitely can be deductible as a expenditure under 24B while computing house property income. All right. So I think by that first adjustment is completely over, because we adjusted that interest of 200 and 300. Along with that, we have considered that respective incomes as well, that debenture interest income also, and along with that, we have adjusted that house property rental income as well. Now moving on to adjustment number 2, expenses relating to house property let out are 40% of repairs and renewal expenses. So the expenses relating to house property let out are 40% of repairs and renewal expenses. So let's go and check the repairs and renewal. Out of this repairs and renewal, that is 2,200, 40% is in relation to repairs of your house property. That's what they're saying. Yes or no? So 2,200 into 40% will give you 880 rupees. So this 880 rupees is not your business expenditure. It is totally in relation to your house property repairs and maintenance. All right. So what you need to do, you need to add back that particular expenditure from your taxable business profits. Repairs to house property. And what was the amount? It is 880 rupees. Can you deduct it as an expenditure from the house property income? Can you deduct that 880 rupees as an expenditure from your house property income? The answer is no. Under house property, the only available deductions are municipal taxes paid, then 30% standard deduction, and then 24B interest on loan deduction. These are the only deductions that you can claim. Apart from these, you are not supposed to claim any other deduction from the head house property. All right. Now, so moving on with the next adjustment, friends, what it says. So we have completed 2 adjustments. Third adjustment, depreciation includes 1,200 on house property let out. So in the depreciation in the debit side, 1,200 rupees is in relation to let out house property. So that 1,200 is not at all a business expenditure. You need to add back that 1,200 your profits. All right. So add back depreciation for house property 1,200. You need to add it up. All right. Now, can you claim that 1,200 as an expenditure from house property again? No, you cannot. Moving on to the next adjustment, friends. Adjustment number 4. Compensation was paid to an employee whose dismissal was in business interest. So a compensation is actually paid to one of your employees, and his dismissal is for your business. It is in relation to your business. So compensation given to employee definitely deductible as a business expenditure. All right. So since it has a close business nexus, that means close business connection, you can claim that compensation paid to your employee as a deduction from the taxable business profits. So for this adjustment or for this point, no further adjustment is required in your computation sheet, because it is definitely a deductible business expenditure from your taxable profits. All right. Moving on with adjustment number 5. Insurance includes 30% for fire insurance of house property let out and 30% for workers' accident insurance and the balance for life insurance. Fantastic. So let's see how much is the insurance amount. It says insurance in total is 4,200. So it says what? 30% is for fire insurance of house property. So out of this 4,200, 30% for fire insurance of house property, 30% for your workers, and the remaining balance portion is for what? Your life insurance policy. So as you know, friends, please listen, 30% for workers' accident insurance is definitely your business expenditure. Premium paid for that 30% is definitely a deductible item under PGBP. But what about fire insurance of house property? Not deductible. And what about your personal life insurance? Deductible under 80C. But in this question, they are only asking you to compute gross total income. So we can simply ignore 30% plus 40%, right? Only 30% for workers' accident insurance is allowable as a deduction from PGBP. So what you need to do, only 30% is allowable. That means the remaining 70% you have to disallow. Yes or no? Only 30% for your workers' accident insurance is allowable as a deduction. That simply means the remaining 70% you need to disallow. So what we can do, we can add back insurance 70%, 30% for house property and 40% for personal life insurance, personal LIC. So what you can do, out of what was the insurance amount, 4,200 into 70% is the disallowance. So 4,200 into 70% disallowance means 2,940 is your disallowance. All right. Now that you need to add back. Moving forward, friends, the next is point number 6. Law charges include 2,000 relating to petition filed against breach of contract and the balance regarding sales tax appeal. So the lawful charges include 2,000 relating to petition filed against breach of contract. So breach of contract, definitely it has a business connection, right? In your business, you have different contracts. Somebody has breached some contracts. You have filed a petition. For that, you had incurred 2,000 as a lawful charge. Definitely deductible item under PGBP. Now, and the balance regarding sales tax appeal. You expended some law charges for sales tax appeals. That is also a definitely deductible expenditure from your business. So for that 2,000, there is no adjustment actually required because definitely it is a business deductible expenditure. Moving forward with the 7th one, subscriptions include 2,000 given for election purpose to political parties. So in the subscriptions, 2,000 rupees actually a donation given to political parties. So donation given to political parties, can you claim it as a business expenditure? The answer is no, it is not your business expenditure. But since the assessee being an individual, he can claim it as a deduction under 80 GGC of chapter 6A. But here you are not supposed to compute 80 GGC because the question is only asking you to compute the gross total income. So what you can do, you can simply add back that 2,000 from your net profit to arrive at the correct taxable business profits. So we can add back political party contribution 2,000 rupees. And then what about the next adjustment? So the following adjustments, that is not debited to your P&L account. So all these three are actually not debited to your P&L account and you need to consider that. Out of that first one, expenses incurred on occasion of festival, 800. So in your business, it is, say, there was some kind of festives were there and you have expended around 800 rupees for your festival. Now the question is whether this 800 expenditure is a business expenditure or a personal expenditure. We don't know because the question is actually not clear whether this 800 rupees is expended for business purpose or your personal purpose. We don't know. If that particular assessee is spending it with his employees, then definitely it is a business expenditure, just like a festive expenditure. But if that particular assessee is expending that 800 for the benefit of family members, then it will be personal. So here we don't know what exactly is the purpose. Since it is given as a part of your question, we are assuming that it is in relation to business. So we are assuming that it is in relation to business because we don't have a choice. All right. So festival expenditure, it is not debited to your P&L. It is not debited to your P&L. So less festive expenditure of 800 rupees. We are deducting it. And moving forward, theft of cash from locker rupees 1200. So there was a theft. You lost around 1200 rupees. Can you claim it as a business expenditure? Definitely yes. Theft, embezzlement, etc. can be claimed as a business expenditure because you're running a business. All right. There are a lot of risks involved in a business. So this thefting of cash is one of the, business risk involved in doing a business. So definitely that 1200 is deductible as a business expenditure. So theft is deductible. And what is that amount? That amount is 1200, right? That is 1200 is definitely allowable as a business expenditure. Now, what about the other one? Expenses for a new telephone connection in business, 2000. So you have incurred some expenses for a new telephone connection, that is 2000 rupees. So definitely that is also deductible because it is for your business itself. So telephone charges for your business, 2000. You can deduct it. So friends, by that, I think all the adjustments are over. Once, if the adjustments are over, now we will have a quick overview of the P&L account. So credit side, gross profit is there. Then interest on debentures we have already dealt with. Rent from house property we have dealt with. Some interest is there. Then compensation is there. Law charges is there. Labor welfare is there. So there is nothing more. All right, there is nothing more in the question. So let's compute the business profits first. So what is the profits from business? Let's compute it together, friends. The net profit is 1,30,000 plus 200 plus 300 minus 10,000 minus 36,000 plus 880 plus 1,200 plus 2,940 plus 2,000 minus 800 minus 1,200 minus 2,000. And what is the sum coming? It is 87,520 rupees. 87,520 rupees is the sum, business profits. Now, what is the IFOS income? And how much is the IFOS income, friends? It is 9,800 rupees. And what about the house property income? Rental income is given. We don't know any other fair rent, municipal value, standard rent, etc. is not given in the question. It is missing. So we will take that rental income itself as the gross annual value. And the question is actually not mentioning about any municipal taxes payment as well. So we are saying there is no municipal tax payment in that year. And hence, from this amount, you can claim a standard deduction at the rate 30%. So from 36,000, 30% is allowable as a standard deduction, that is 10,800. And there is an interest of 300 as well. So minus 300 as well, the income from house property will be 24,900. So by adding these three, what will be the gross total income of the assessee? 24,900 plus 10,800, sorry, 9,800, 9,800 plus 87,520, and that will give you 1,22,220 as your gross total income. Is that clear, friends? Please respond. 1,22,220 is your gross total income from this particular question. Is that clear? Please respond. And friends, one more thing is there. There is a correction in the answer sheet also. Please be attentive. There is one correction. It is there. Loss of cash due to theft. In the answer sheet, it is written as 1,500, but it is only 1,200. All right. The remaining is correct. All the computation, etc. is correct. it is written as 1,500 loss of cash due to theft, and the actual amount is 1,200 only. When you get this PDF, make sure that you have corrected that figure. All right. So friends, let's move on to the next question. So which is that question? It is B part. I think it is 5B. All right. Question number 5, part B. So Mr. X gifted 1,000 shares of a non-domestic company worth 6 lakhs acquired on 15/3/2020 to Mrs. X out of natural love and affection as on 1st April 2020. So we will do one thing. We will draw a flow chart for the better understanding of the question. So Mr. X is there. He gifted around 1,000 shares. Gifted 1,000 shares of a non-domestic company. So we will write 1,000 shares itself of a non-domestic company worth 6 lakhs. All right, 6 lakhs to Mrs. Y, not Mrs. Y, Mrs. X. So out of natural love and affection. So the first thing that you need to take care is whether natural love and affection can be treated as an adequate consideration. The answer is no. You cannot treat natural love and affection as an adequate consideration. So this is just like a gift given by the husband to his wife. Yes or no? So definitely clubbing provisions will come into picture. Now let's read that question further. So on 31st January 2021, Mrs. X received a dividend of 60,000 on such shares in India. So Mrs. X got a dividend. Mrs. X got dividend. After transferring, she got dividend from that particular shares. That dividend amount is rupees 60,000. All right. Now, then what else is there? On 1/2/2021, Mrs. X sold such shares for 10 lakh and received consideration in India. So Mrs. X has sold all the shares for 10 lakh rupees. He sold that entire shares for 10 lakh rupees. All right. Then what she did? She showed the tax treatment if on 1/2/2021 she invested 10,60,000 in case A house property from which rent accrued in the previous year is 2021 is 53,000. Case B, a newly formed partnership firm contributed initial capital and interest received taxable portion on such contribution is 13,250 and share of profit is 20,000. And case C, a newly started proprietorship business and contributed capital profit accrued from the year is 42,400. So there is 3 alternatives, A, B, C. In 3 alternatives, she has invested in 3 different sources. Now you must tell what is the taxability in the hands of Mr. X and Mrs. X. So by considering clubbing provisions. You need to consider clubbing provisions while solving this particular question. All right, friends. So we will take case A first. We will take case A first. Then we will move on to the remaining item. Case A, what she did, she invested that entire 10,60,000 in a house property. So case A, investment in a house property. How much she have invested? She invested this 10 lakh along with the 60,000. So that makes it 10,60,000. All right. Now the question asks you to show the tax treatment of that. If house property rent received by Mrs. A in that year is 53,000, what is the tax impact of this 53,000? That's what you are supposed to compute. All right. So let's have a very detailed discussion, friends. Mr. X transferred shares of worth 6 lakhs. So from whatever income which you have accrued from this 6 lakhs, that is definitely taxable in the hands of Mr. X itself. Yes or no? Income from transferred asset will be clubbed in the hands of transferor. Yes or no, friends? So here, Mrs. X got 60,000 as dividend. All right. So that 60,000 dividend, 60,000 is definitely taxable in the hands of Mr. X. because it is direct income from the transferred asset. Now, after that, Mrs. X sold this shares for 10 lakh. So there is a gain of 4 lakh. Yes or no? When Mrs. X sells that particular shares of worth 6 lakhs for 10 lakh, there is a gain of how much? 4 lakh. And what will happen to that gain? That short-term capital gain also, 4 lakh also will be taxable in the hands of Mr. X. That means in the hands of husband. Now, what she did, she invested 10,60,000 in house property, and the house property is giving back a return of 53,000. In the morning, I've told you one thing. What was that? If there is income from accreted income, right? If there is an income generation from accretion of assets, that is not what the clubbing provisions will never attract on income from accretion of asset. Do you remember that point? If there is some income generation from accretion of asset, from accretion of transferred asset, that will not be subjected to the provisions of clubbing. All right. So how much is the accretion of asset here? How much is the accretion of asset? The asset which she got is only 6 lakhs. And now she has 10,60,000. So tell me, friends, how much is the accretion of asset? How much is the accretion of asset? It is 4,60,000. Yes or no? The 4,60,000 rupees, the accretion of asset. How it become 4,60,000? Mr. X transferred only 6 lakhs worth of asset. From that 6 lakhs worth of asset, she got a capital gain of 4 lakh and along with that a dividend income of 60,000. So that 4,60,000 is definitely accretion of asset. Yes or no? So what happens is, out of this 53,000, out of this 53,000 rupees, you know it is from house property. From that, you can claim standard deduction 30%. There is a standard deduction of 30%, and 53,000 into 30%, it would be 15,900. So after reducing standard deduction, what is the net income? 37,100 is the net income from house property. This have to be clubbed. This have to be proportionated and clubbed. All right. This 37,100 is by investing 10,60,000. Out of that, 4,60,000 is income from accretion of asset. And for that 4,60,000 proportionate, proportionate income from house property is not required to be clubbed. So 4,60,000 into 37,100 divided by 10,60,000. How much will be the figure? 4,60,000 into 37,100 divided by 10,60,000. It would be 42,137. 137. So 42,137. That particular, oh, sorry, there is some mistake. There is some calculation mistake. One second, friends. 37,100 divided by 10,60,000 into 4,60,000. It would give you 16,100. It is only 16,100. So the 16,100 will be taxable in the hands of Mrs. X. Mrs. X. And the remaining, what is the remaining portion? 37,100 minus 16,100, that is remaining 21,000 will be taxable in the hands of Mr. X. And the total income to be clubbed in the hands of Mr. X. How much is the total income clubbed in the hands of Mr. X? 21,000 is the proportion of income from house property, then 60,000 from dividend, and 4 lakh on account of capital gain. So the total is 4 lakhs plus 60,000 plus 21,000, and the total income is 4,81,000 rupees to be clubbed in the hands of Mr. X. Is that clear, friends? Please respond. Now case B. Case B. And what is case B? Case B, it says, she invested that 10,60,000 in a newly formed partnership firm and contributed initial capital, and interest received taxable portion on such contribution is 13,250 and share of profit is 20,000. So let's see. So Mrs. X has invested that particular 10,60,000 in a partnership firm, a newly constituted or newly commenced partnership firm. And the partnership firm has given interest on capital And what was the interest on capital given by the partnership firm? It was 13,250. And there is share of profit as well. Share of profit from the partnership firm is also given, that is 20,000. As you know, this share of profit is fully exempted under section 10(2)(a). The share of profit received by the partner is fully exempted under 10(2)(a). So there is no requirement of any clubbing. All right, that 20,000 is anyway fully exempted in the hands of that recipient partner. So clubbing provisions are actually not required to be invoked. Now, what about interest on capital? Interest on capital is definitely taxable in the hands of partner under section 28. All right. So we need to bifurcate this interest on capital. So that 13,250 interest on capital is accrued from investment of 10,60,000. Yes or no? He invested 10,60,000 in that particular partnership firm to accrue an interest of 13,250. Out of that, 4,60,000 is income on accretion of asset. So that much portion is not required to be clubbed. So this will be taxable in the hands of Mrs. X. So 13,250 divided by 10,60,000 into 4,60,000 will give you 5,750 rupees will be taxable in the hands of Mrs. X. And what about Mr. X? Mr. X, the remaining 13,250 minus 5,750, the remaining portion of 7,500 rupees, along with that 60,000 rupees dividend, along with that 4 lakh short-term capital gains, will be taxable in the hands of, will be clubbed in the hands of Mr. X. So what is the total income of Mr. X, friends? It is 7,500 plus 4,60,000, and that would be 4,67,500. Is that clear? Please respond. Is that clear? So 5,750 rupees will be taxable in the hands of Mrs. X on account of clubbing provision, and the remaining portion will be taxable in the hands of Mr. X. This is on account of clubbing provision, and here there is no clubbing provision. 5,750. For that 5,750, there is no clubbing provision because it is the proportionate income from accretion of asset. All right. Now, moving forward with question number C. It is a newly started proprietorship business. Contributed capital and profit accrued is 42,400. So if she is investing 10,60,000 in a newly started proprietorship business, and the profit accrued is 42,400, how to deal with that? It is pretty simple. It is a proprietorship business and its profit is 42,400. All right, its profit given is 42,400. Now how to proportionate it? Divided by 10,60,000 into 4,60,000 will be taxed in the hands of Mrs. X. So 42,400 divided by 10,60,000 into 4,60,000, 18,400 will be clubbed in the hands of Mr. X. Sorry, Mrs. X, not clubbed, taxable in the hands of Mrs. X. And clubbing provision for Mr. X will be 42,400 minus 18,400 is 24,000 plus dividend income of 60,000 plus short-term capital gain of 4 lakh. And in total 4,84,000 will be clubbed in the hands of Mr. X, and 18,400 is taxable in the hands of Mrs. X as well. I hope it is clear. All right. So moving on to question number 6. So let's deal with question number 6A now. What is question number 6A? First of all, let's read that question, then we will solve the answer together. Mrs. Priyanka Mehta is a professor in the Department of Commerce in Calcutta University. Following are the particulars of her income for assessment year 21-22. So a lot of informations have been given. Now let's understand what is the objective of the question. You are required to compute her total income for assessment year 21-22. So they are asking about the computation of total income. All right. So we will write a separate note for that. Computation of total income. So computation of total income. Now let's go to the question. Basic pay 60,000 per month. He received some salary and basic pay is 60,000 per month. So what you need to do? Basic 60,000 per month into 12 months, and the sum it would be 7,20,000 rupees. Now, what is the next item? DNS allowance is 30% of the salary. So 30% of the basic pay is the DNS allowance. Now let's take 30% of 7,20,000 into 30%. It would be 2,16,000 is the DA. 2,16,000. So 7,20,000 into 30% is the DA. Now, moving on to the third item, house rent allowance 30% of basic salary. So she have received a house rent allowance, HRA. And what is the actual HRA she received? It is 30% of basic salary, right? So house rent allowance is also 30% of basic salary, and the actual amount she received is 2,16,000. So for house rent allowance received from the employer, there is an exemption under 1013A. Hope you remember that. What was the exemption under 1013A? The act says either the actual HRA received or 50% of the salary if the house is situated in the metro city, or in the case of house is situated in some other city, it is 40% of the salary, or rent paid minus 10% of the salary. Whichever is lower shall be the exemption under 1013A. Hope you remember this exemption. All right. So let's compute the exemption. Under section 1013A, we will write a working note number 1. All right. So working note number 1. Under section 1013A, what is the exemption? Either actual HRA received. And what is the actual HRA payment received here? It is 2,16,000. Or 50% or 40%. Let's see in which city that house is situated. So is there any information in relation to that? Let's see. From in the starting point of the question, it says Calcutta, right? The house, I think it is in Calcutta. So she is a professor in the department in Calcutta. So Calcutta is definitely a metro city. Yes or no? In the question, from the starting point itself, they have stated that she is in a metro city, that is a Calcutta. So that means 50% of the salary. Now 50% of salary is the limit. Now friends, what do you mean by salary for HRA exemption? For HRA exemption, salary means basic salary. Salary here means basic salary plus DA if form part of retirement benefit plus commission if it is expressed as a fixed percentage of your turnover. So here we know the basic salary, and how much is the basic salary? It is 7,20,000. We know the DA, but they are not stating anything whether DA forms part of a retirement benefit or not. We don't know. So we are assuming that DA does not form part of the retirement benefit. So we are not taking DA, and there is no commission information in the question. So the salary would be the 7,20,000 itself. So 50% of the salary means 7,20,000 into 50%, and that is 3,60,000 rupees as the second limit. And what is the third limit? Rent paid minus 10% of salary. And how much is the rent paid in the question? It is 28,000 per month. So 28,000 into 12, it is 3,36,000 is the rent paid. Minus 10% of the salary means 72,000 rupees will come. 7,20,000 into 10%. So friends, 3,36,000 minus 72,000, it would give you 2,64,000 as the third limit. So friends, tell me whichever is lower. Which is the lower limit? 2,16,000 itself is the lower limit. So the exemption under 1013A, 2,16,000, you will get the full HRA as exemption. All right. So we will note it down. 1013A, we can claim that 2,16,000 in full as an exemption, and there is no taxable element there. Now, moving forward with the next adjustment in the question, it says medical allowance 6,000 per month per annum. Amount actually spent on treatment is 2,000. So the medical allowance received is fully taxable right now. There are a few exemptions for that, but generally, whatever you have received as a medical allowance, that entire amount is taxable as a benefit. So, medical allowance, that is 6,000 is the medical allowance, right? Medical allowance is 6,000 per annum. So, full 6,000 is taxable. Now, what about the next adjustment, friends? It is wardenship allowance. Wardenship allowance means you are appointing a warden. All right. And for that, you are getting an allowance of 1,000 rupees per month. So that is fully taxable allowance. Wardenship allowance is 1,000 into 12. That is full 12,000 will be a taxable element under the head salaries. Now, rent from house property is 2,000 per month. That is actually your income. Rent from house property means what? Your rental income. You have got a rental income, and that will be taxable under the head house property, not under salary. So what you can do, that 2,000 per month, you can consider it under a separate head, that is house property. Rent received is 2,000 into 12, and that is 24,000 rupees will be your house property income. Now, moving on to the next item, friends, interest received from government securities, 5,000. That will be taxable under which head? That will be taxable under IFOS. Income from house property will be definitely taxable under, not house property, income from, it is interest income from government securities, right? That will be definitely taxable under IFOS. So we will write that separately again. IFOS, interest on securities. And how much is the income? It is 5,000 rupees. Now, friends, moving forward, dividend received from Indian company, 1,500. So tell me, friends, what is the impact of dividend received from Indian company? Earlier, it was exempted. Earlier, dividend received from Indian company was fully exempted. But February 2020 annual budget has removed that particular exemption under 1034. And now, whatever dividend you have received from an Indian company, it is fully taxable. So that 1,500 rupees is also dividend from Indian companies. 1,500 is fully taxable under IFOS. Now, moving forward, friends, interest on savings bank deposit, 62,000. So interest on savings bank deposit definitely taxable under IFOS. So interest on savings bank deposit. And how much is that amount? 62,000 rupees. And as you know, interest on savings bank deposit, you can claim a deduction under Chapter 6A. And how much is the deduction? Under Chapter 6A, under section 80 TTA, up to 10,000 rupees, you can claim it as a deduction. So the interest income up to 10,000, you can claim it as a deduction. So 80 TTA deduction is up to 10,000 rupees. Now, friends, moving forward, contribution to recognized provident fund is 10% of basic salary. Hope you remember, up to 12% of basic salary contribution to recognized provident fund is fully exempted, up to 12%. All right. And there will be employer contribution as well as employee contribution. Yes or no? There will be employer as well as employee contribution to a recognized provident fund. So what we can do? We can write it separately. Employer contribution to recognized provident fund, and the amount is, how much is the amount? It is 10% of the salary. That means 21,600. Full amount you can claim it as an exemption, because up to 12% of salary amount you can claim it as an exemption. So the full 21,600 is not taxable under the head salaries. Now, friends, there is one more thing. Definitely there will be employee contribution. All right. So how much will be the employee contribution? If nothing specifically given, the same amount will be the employee contribution as well. Normally you know that both the employer contribution and the employee contributions are same. All right. Here in the question, they are only saying 10%. Here they are only saying contribution to recognized provident fund is 10% of the basic salary. So what should be its meaning? That simply means 10% of the basic salary is contributed by the employer, and another 10% of the basic salary is contributed by the employee as well. All right. So for the employee contribution out of his pocket, if the employee is contributing something to a recognized provident fund, then what will happen? That portion is definitely allowable as a deduction under Chapter 6A 80C. So what we can write under Chapter 6A, under Section 80C, 21,600 is definitely allowable as a deduction. How the 21,600 came in? Let's see. Not 21,600, sorry. How much was the salary? It was 72,000, 7,20,000, right? Okay. So there is a correction, friends. There is a correction. Employer contribution to RPF is 10% of the salary. All right. So it is 72,000. And the full 72,000 is the exemption amount. I have written it as 21,600. It was actually 72,000. And the employee contribution is also 72,000. All right. Employee contribution to ATC is also 10% of 7,20,000. So that means it also will be 72,000 rupees, because contribution to recognized provident fund is allowable as a deduction under Chapter 6A ATC deduction. All right. So that is the end of that particular adjustment. And moving on to item number 11, premium paid by check on medical insurance policy of health of dependent mother, 5,000, 2,000 for dependent mother-in-law, and 1,000 for dependent brother. So it is under 80D deduction item. All right. If you are paying a health insurance otherwise than by cash, then for the health insurance premium paid for your mother, definitely allowable as a deduction. What about mother-in-law? For mother-in-law, you cannot claim any deduction under 80D. It is not possible. What about for dependent brother? Again, for dependent brother also, you cannot claim any deduction under 80D. And hence, the 80D deduction only will be rupees 5,000. Because health insurance premium paid for dependent mother only will be allowable as a deduction. All right. So, deduction under 80D, health insurance, 5,000 rupees is allowable as a deduction under there. Now, donation to an approved charitable institution, rupees 1 lakh. So there you have given a donation to approved charitable institution. So this is covered under section 80G. So under 80G, we will write a separate working note, 80G, working note number 1. So friends, please listen. Under 80G, I've told you there are 4 categories of donations. Category number 1, 100% deduction is allowable without any ceiling limit. Category number 2, 50% of the donation is allowable as a deduction without any ceiling limit. Category number 3, 100% of donation is allowable as a deduction subjected to ceiling limit. And category number 4, 50% of the donation is allowable as a deduction subjected to ceiling limit. And this contribution or donation given to this particular charitable institution comes under the 4th limb. That means 50% is allowable as a deduction subjected to ceiling limit. All right. Now let's compute the ceiling limit first. Let's compute the ceiling limit. Ceiling limit means 10% of adjusted gross total income. Ceiling limit under 80G means it is 10% of adjusted gross total income. Now friends, what is adjusted gross total income? Adjusted gross total income simply means the gross total income. Take the gross total income, deduct from the gross total income, you are supposed to deduct certain chapter 6A deductions except 80G. So for the time being, we are not computing 80G because for computing 80G, we should know what is the adjusted gross total income. All right. So for the time being, we are halting this computation. We will do it later. All right. Yes. Moving forward with the house rent paid, 28,000 that we have already considered for HRA. For HRA, we have already considered that 28,000 per month. Now friends, by that we are able to compute our gross total income. First, let's compute our taxable salary income. So what is the gross salary taxable? What is the gross salary taxable here in this question? 7,20,000 plus 2,16,000 plus 6,000 plus 12,000. The gross salary taxable would be 9,54,000. 9,54,000. From that, you can claim a standard deduction at rupees 50,000 rupees is the standard deduction. So after claiming that 50,000 rupees, the taxable amount will be 9,04,000. This will be the taxable salary. Now, house property, we have 24,000. From that, you can claim a standard deduction at the rate 30%. So from 24,000 into 30% of standard deduction, it would be 7,200. And the remaining taxable income is 16,800. All right. Now, what about the next one? Income from house property is there. All right. Income from house property, income from other source. In total, 5,000 is there. 1,500 dividend income is there, and 62,000 rupees interest on savings bank deposit is there. So the total, it would be 68,500. So tell me friends, what is the gross total income in the question? 68,500 plus 16,800 plus 9,04,000 rupees, and in total it is 8,89,300. So in total it is 8,89,300. Sorry, 9,89,300. 9,89,300 is the gross total income. All right. From chapter 6A deduction, we are supposed to compute one more chapter 6A deduction. Now we can compute that chapter 6A deduction because we got the gross total income now. So let's move and compute that ATG deduction. So the gross total income is 9,89,300 into 10% means how much is the 10% of that? 98,930 rupees is the maximum amount of deduction. 98,930 rupees is the maximum amount of deduction. All right. Now, friends, what is the actual contribution given to that particular charitable institution? The actual contribution given to the charitable institution is 1 lakh. All right. This is the actual contribution is rupees 1 lakh. You can claim only up to 98,930. And on that again, there is another limit of 50,000, 50%. So as I've told you, if you are contributing something to a ATG, under ATG charitable institution, that will come under the 4th category. And what is that 4th category? 4th category, it says 50% of the contribution subjected to ceiling limit. And your ceiling limit is 98,930. So 98,930 into 50% will be the deduction. 98,930 into 50%, it will give you 49,465 rupees as the deduction. So chapter 6A deduction, let's compute. 49,465 is the deduction. So now friends, we are able to compute the total income of from this question. Your gross total income is 989,300. From that you can deduct ATC, ATTTA 10,000, ATC 72,000, then ATD 5,000 and ATG 49,465. And the total income would be, 8,52,835 rupees. Is that clear, friends? So friends, moving on to the next question, that is 6B. All right, so let's read 6B and let's move forward. So X and Y, being members of an AOP with equal ratio, furnish the following details. Compute the tax liability of AOP and members. So X and Y being members of an association of persons. And now in this question, you need to compute the total income of Mr. X, the total income of Y, and the total income of the association in which they are members as well. So Profit and loss for the year ended 31st March 2021 is also given. Bonus to employees there, gross profit is there. Then other expenses, salary to Mr. X and Mr. Y, interest on capital at 15% given to Mr. X and Mr. Y, depreciation at this under section 32, then net profit. Then in the credit side, there is brought forward, what do you say? In the credit side, there is gross profit, that is 60,000, and short-term capital gain 6,000 as well. Now, there are some additional information given in the question. Other expenses include expenditure of 4,000, which is disallowed under section 37. And now, other personal income of Mr. X and Y, apart from share of income or apart from the interest or remuneration, whatever it is from that particular AOP, they have some other personal incomes as well. And what are the incomes? It is dividend received 5,000 for Mr. X, and Mr. Y it is 20,000. Then interest on loan 20,000 and 2,29,000. Then brought forward loss from house property is 25,000 for Mr. X and 10,000 for Mr. Y as well. So from these informations, you are supposed to compute the total income of X, Y, and the AOP. And let's start doing the question together. So first of all, before start solving the question, let me make one point very clear. It is the computation of tax of an association of a person. It is depicted in this particular flow chart for a better understanding. So let's discuss this flow chart together first, then only we will move on to solve that particular question. So computation of tax, how to compute the total income of an association of person. So please listen, friends. Where the shares of members in an AOP or BOI are unknown. Say, for example, you don't know how much percentage of shares are to Mr. X or to Mr. Y. We don't know that share of profit which is receivable by Mr. X or Y. That means the members. Then how the taxation will be. Then that particular association of person is taxed at what rate? At maximum marginal rate. And what is the maximum marginal rate? It is 30% plus surcharge 37% plus cess 4%, and it would be 30% plus 37% plus 4% cess, and it would be 42.744% itself. And now, however, if total income of any member of AOP or BOI is taxed at a rate higher than MMR, then such rate. All right. So the point is very clear. It is where the shares of AOP and BOI are unknown. We don't know how much is the share of each members of an AOP. Then how the taxation will be. That particular AOP or BOI will be taxed at a rate that is 42.744%. It is called maximum marginal rate. Now, what if this MMR rate is of the AOP or BOI? And this rate is based on whether AOP share of profit to their members is determinable or not. All right. Now, let's understand the other one. If the individual share of members is known, if you know the individual share of members, then how the taxation of AOP and BOI, let's understand. Now, the first thing that you have to check whether the total income of any member, excluding his share from AOP or BOI, exceed basic exemption limit. Say, for example, you are a member of an AOP or a BOI. All right. That members and your share in that AOP is very clear. It is already determined. You know how much is your exact share of profit from that particular AOP. All right. Then how to compute the rate of tax for that particular AOP? It is the total income of any member, excluding the share from AOP or BOI, exceeds basic exemption limit, then the rate of tax for AOP or BOI will be, it is assessed at MMR. However, total income of any member is assessed at a higher rate than that particular rate. Then proportion of income attributable to such member is assessed at such rate, and the balance at MMR. It is very simple, friends. I'll make it very clear. Say, for example, I'm one of the members of an AOP. All right. From that particular AOP, I'm receiving an income, and I know how much the income every year. There is a determined percentage of profit. All right. In that case, how to consider or how to compute the rate of tax of that AOP or BOI? It is very simple. You take the total income of that members, total income of different members. If the total income of different members, excluding the share of profit of AOP or BOI, if it exceeds basic exemption limit, say my total income without considering the share of profit from AOP or BOI is say 5 lakh. As you know, the basic exemption limit for a normal person is only up to 2,50,000, and my total income excluding the share of profit from AOP, if it is 5 lakh, then what happens, you know, it is over and above the basic exemption limit, yes or no? And hence what will happen? Hence that particular AOP or BOI again is assessed at what rate? At MMR. And what is the MMR rate? At 42.744%. All right. Now, if the individual shares of the members are non and no member has total income excluding his share from AOP or BOI exceeding basic exemption limit. Say for example, I am a member of AOP or BOI and my percentage of profit is already determined, but my total income excluding the share of AOP or BOI is less than the basic exemption limit or equal to basic exemption limit. Then what will happen? That AOP or BOI is taxed at what rate? It is taxed at normal rate applicable to an individual. That simply means that AOP is supposed to compute their taxes on a normal slab rate based on the old normal slab rate. And what is the old normal slab rate? Up to 2,50,000 nil, then 2.5 to 5. It is 5%, then 5 to 10, 20%, 10 above 30%. That slab rate will be applicable for that particular AOP or BOI. I hope this much is clear. So now you know how to compute the rate of tax of an AOP or a BOI. It depends upon the share of profit, all right, of members. So that's what we have discussed it in this particular flowchart. Now let's go back and discuss that particular question and let's solve the answer together. First, we will compute the profits of what? Of AOP. So the profit and loss account of AOP is given in the question. I will pick the net profit as usual. So computation of profit of association of person. We will compute the profit of AOP first and we will start with that. So as the question says, the net profit from their activity is rupees 15,000. Now we will move on to the additional adjustment. Then we will come back and have a look on the particular, on the particular P&L given. All right. So the net profit in the question, it is 15,000. And in the additional adjustment side, they have given other expenses include expenditure of 4,000, which is disallowed under section 37. So in the additional expense, they have very clearly stated other expenses include an expenditure of 4,000, which is disallowed. So there is a thing called other expenses. In this, 4,000 is disallowed. Since it is already debited to your P&L account, you need to add back that 4,000 to your profit to arrive at the taxable profits. Yes or no? So first we will do that adjustment. Add back disallowance under section 37. We don't know what exactly is that disallowance. They have given in the question there is a disallowance. So I have added it back. Now in the additional adjustments, they haven't given any other specifics. That is the only additional information. Then the personal income of Mr. X and Mr. Y, that means the members are also given. Now we will have a quick overview on the P&L of that particular AOP. That is bonus to employees is there. It is 5,000 rupees. Not a problem. It is allowable as a deduction. Other expenses we have already dealt in. Salary to Mr. X and Mr. Y. Can an AOP or a BOI claim remuneration paid to its members as a deduction? The answer is no. 40BA specifically states that if an AOP or BOI gives out any remuneration or interest to its members, then that equivalent amount will not be claimed as a deduction. That will be 100% disallowance. That is the difference between basically a partnership firm and AOP or a BOI. For a partnership firm under 40B, there are certain ceiling limits for the remuneration as well as interest on capital paid to their partners. But for an AOP or BOI, they cannot claim any deduction on the interest on capital or remuneration paid to its members. That is the prime difference between an AOP or a BOI or with a partnership firm. So what we can do here is we can add back the salary 5,000 to the net profit to arrive at the correct taxable profit. So salary to members, I'm adding back salary to members, 10,000 I will add back. All right. Now interest on capital also we need to add back. Interest on capital. And what is the interest on capital in the question? The interest on capital, it says 5,000 and 7,000. In total it will be 12,000. So that 12,000 also I am adding back to the profit. Now, what is the taxable profit from this, and from then is there any adjustment in the P&L? 5,000, 7,000, depreciation 10,000. Definitely depreciation is a deductible expenditure, right? Now there is a short-term capital gain of 6,000. So short-term capital gain have to be taxed under the capital gain set. All right. So we will less short-term capital gain 6,000 from here, and we will take capital gain head. Capital gain head is there. That is short-term capital gains 6,000 rupees will come there. So here it should be deducted, and there it should be added back. Now friends, how much is the taxable business profit? So profits from their activities. Let's compute the profits from their activities. It is 15,000 plus 4,000 plus 10,000 plus 12,000 minus 6,000. It would be 35,000 is the taxable profits. 35,000 is the taxable profits, and short-term capital gain 6,000, and in total income, there is no chapter 6A deduction, so the total income would be 41,000 rupees. So this is the total income. So now we need to know how to tax the particular AOP. We don't know how to tax because it depends upon the what? It depends upon whether share of profit of members is non or unknown, and it depends upon how much the total income each members have, excluding the income, that means excluding the share of profit from AOP. That's what we have learned right now. Now friends, let's go back and have an overview on the question. So the first statement of the question, X and V being members of AOP with equal ratio. What is equal ratio? However, how much is your profit? That profit will be equally divided. So the share of profit of each members, it's already known, it's already determined. All right. Now we need to check if the share of each members, if we know that, then how to determine the rate of tax of partnership firm? Sorry, how to determine the rate of tax of AOP or BOI, not the partnership firm? It is very simple. You need to compute the total income of Mr. X and Mr. Y, excluding the share of profit from this particular AOP. If that total income is over and above basic exemption limit, then that AOP is taxable at MMR. Otherwise, that AOP is taxable at a normal rate. That's what we have learned. Now let's compute the profits of this Mr. X and Mr. Y. So computation of profits, or rather than profits, we'll use total income of Mr. X first, then Mr. Y. All right. So let's take the income of Mr. X and Mr. Y. So in the question, it is very clear, dividend received. There is a dividend. Dividend received. Now dividend is fully taxable. Earlier it was exempted under 1034. As you know, in February 2020 annual budget, there was a drastic amendment. They have withdrawn the dividend distribution tax. They have withdrawn the 1034 exemption, and they have withdrawn that 115 BBDA. It is for repeaters. All right. If you are a fresher, you don't need to worry about dividend distribution tax, 1034 exemption, 115 BBDA taxes, because right now, from financial year 2021 onwards, these three sections are completely revoked. Okay. So the dividend received by any shareholder or any member or any person will be fully taxable in the hands of the recipient as a normal income. All right. So the dividend is 5,000 for Mr. X and 20,000 for Mr. Y. And interest on loan they have. And how much is the interest? 20,000 for Mr. X and 2,29,000 for Mr. Y. Now there is a brought forward house property loss. So under section 71B, Income Tax Act is very much clear. If you have a brought forward house property head loss, you can set it off, that particular loss, only with income from house property. See, if there is a current year house property loss, you can set it off with house property head or any other head, subject to a limit of 2 lakh. But once if there is a brought forward house property loss, what do you mean by brought forward house property loss? That loss will be from any preceding years. If you have once you have brought forward that house property loss to subsequent year, that can be set off only with profits from house property head. All right. So here, can you set off this house property head loss there is a loss of 25,000 and another loss of 10,000. Can you set it off with these incomes? The answer is no, you cannot. So the house property loss, you cannot set it off. Why? Because there should be income from house property, then only you can set it off. So the total income of Mr. X and Mr. Y, excluding the income, that means excluding the share of profit from AOP, will be, here it is only 25,000 rupees, and the other case it is 2,49,000 rupees. So both are less than the basic exemption limit. Basic exemption limit of rupees 2,50,000. So excluding the share of profit from this particular AOP, their incomes is only up to 25,000 and 2,49,000. Both are way below the basic exemption limit. Not way below, 249 is very much close, but again it is less than 2,50,000, and hence we can say the AOP is taxed at what rate? At the normal slab rates. Yes or no? But again, normal slab rate means normal slab rates, but there is a problem, not a problem. Their total income is only 41,000. If the total income is only 41,000, then their basic tax would be what? Nil, because they can take out the benefit of basic exemption limit, and basic exemption limit is up to 2,50,000. They are eligible. So the total income of this particular AOP or BOI is nil. Why? Because they are so not total income, sorry, the basic tax. The tax payable by AOP or BOI shall be zero, nil. Why? Because their total income is less than basic exemption limit, and slab rates are applicable for them as well. Yes or no? Now let's move on to compute the taxable income of Mr. X and Mr. Y. All right, taxable income of Mr. X and Mr. Y. Now friends, please listen. Please listen. Mr. X and Mr. Y, we will say other incomes. So in the case of Mr. X and Mr. Y as other incomes means income apart from income from AOP. All the incomes apart from income from AOP. So other incomes is 25,000. We have already computed. In the other case, 2,49,000. Now they got a salary. They got something called salary from this AOP, and that salary, how much is the salary amount? To Mr. X it is 5,000, to Mr. Y it is 5,000. Now they got something called interest on capital, and to X it is 5,000, to Y it is 7,000. Yes or no? Now how much is the remaining income? What is the remaining income of AOP? So as you know, the total income is 41,000. From that, 5,000 means 10,000 they have distributed as salary. 12,000 they have distributed as what? They have distributed as interest on capital. So 41,000 minus 10,000 minus 12,000, the remaining income will be 19,000. Yes or no? This 19,000 they will distribute equally. All right, this 19,000 will be distributed equally between the partners. Now let's compute how much is that particular income. So please listen, 19,000 divided by 2 is 9,500. 9,500 each, it will get distributed among that particular partners. So 9,500 for Mr. X and 9,500 for Mr. Y. Now let's compute the total income of Mr. X and Mr. Y. So total income of Mr. X and Mr. Y, that is 25,000 plus 5,000 plus 5,000 plus 9,500, it would be 44,500. All right, now total income of Mr. Y, it is 2,49,000 plus 5,000 plus 7,000 plus 9,500. It would be 2,70,500. Now friends, let's check one more thing, whether they are asking to compute total income or taxes. From the compute tax liability of AOP. All right, so we need to compute the tax liability of the members as well. So let's compute the tax liability. Basic tax in the first case, nil. Why? Because his total income is only up to 44,500. Now in the second case, even though it is 2,70,500, and what is the age of Mr. Y? We don't know. We don't know the age of Mr. Y. But again, 2,70,500 is the total income in the case of Mr. Y. So up to 2,50,000 they can claim as a basic exemption limit, and 2,70,000 minus 2,50,000, it would be 20,500 into 5%. 20,500 into 5% means 1,025. From that, he can claim the benefit of rebate under section 87A. There is a thing called rebate under 87A. So the full 1,025 he can claim as a rebate, and hence the tax liability would be nil. So Mr. Y also, the tax liability is nil. So hence the conclusion of the question is, for Mr. X the tax liability is nil, and for Mr. Y the tax liability is nil. I hope that question is clear. The only thing you need to know is how to compute taxes of AOP. It depends upon the members' share and members' total income, and I hope it is well clear. So let's move forward. Moving on to the next question, that is question number, it is 7A. Moving on to the next question, that is question number 7A. So what is 7A, friends? Compute gross interest or dividend and net interest or dividend on securities and shares in the following cases. So in the following cases, you need to compute your gross income, dividend portion, and the net income as well. All right. So, all right, we will make a table, and the table is particulars, then gross income, then TDS, TDS amount, then net income. All right. Yes. So we will discuss each and every point. That is 10% of bonds of Industrial Development Bank of rupees 3,20,000. So it is like you received an amount. All right, that's what they are saying. You have accrued an income, and that is 10% bond of an Industrial Development Bank of India, and the amount is 3,20,000. So we know the gross income. How much is the gross income here? It is 10% bond, all right, and the bond's value, the value of bond is 3,20,000. So the income would be 10% bond, and the income would be 3,20,000 into 10%, and that would be 32,000 rupees. And what will be the TDS? TDS will be under section 193, and as you know, due to this corona pandemic, there is a reduction in the rate of tax. The normal rate under section 193 is 10%, and if the TDS payment, or if the payment is accrued or paid between 14th May 2020 till 31st March 2021, if the payment is made between 14th May 2020 to 31st March 2021, then the applicable rate of tax would be 7.5%. This is a this is a benefit. All right, this reduction of 25%, there is a reduction of 25%, right? Your normal rate is 10%, there is a reduction of 25%, that means your current rate is only 7.5%. All right, and this benefit is only applicable for those payment which is accrued or paid between 14th May 2020 to 31st March 2021. So under section 93, now you are supposed to deduct TDS only at 7.5%. So 32,000 into 7.5%, it would be 2,400 rupees will be the TDS amount. Okay, not here. Here 2,400 rupees is the TDS amount. And what is the net income? Net income would be 29,600 is the net income. All right, so that is the adjustment number 1. Now adjustment number 2, it is only an easy question. Okay, what is adjustment 2? 10% debentures of PQR Limited listed on Kolkata Stock Exchange purchased at 96 rupees and face value rupees 100 is rupees 134,400. So there is a debentures of PQR Limited, all right, and the 10% debentures of PQR Limited listed on Kolkata Stock Exchange at 96 and face value is 100. All right, rupees 134,400. That's what they are saying. So let's compute the impact of this particular thing. Friends, please listen. Okay, friends. So how to compute this particular item? Let's see. So from the question, it is very clear that you will write a working note for that. All right. So from the question, it is very clear that you have some debentures. You have purchased some debentures for 96 rupees. All right. So you purchased for some debentures for 96 rupees. We don't know how many debentures you have purchased, but The total value of debentures you have is 134,400. That's what they are saying. So it says 10% debentures of PQR Limited listed on Kolkata Stock Exchange, purchased at rupees 96 and face value rupees 100 is rupees 134,400. So 96 rupees you purchased, the total amount is 134,400. Now, so how many number of debentures you have? Number of debentures you have will be 134,400 divided by 96 rupees per debenture. That would give you 134,400 divided by 96 rupees per debenture. That is 1,400 debentures. 1,400 debentures of face value, 1,400 into 100 per debenture, and the face value total will be 1,40,000 rupees. Now there is an interest at 10%. The interest computation will be not on your purchase cost. It will be always on the face value. Both the debentures and interest are normally computed at the face value of debentures. So 10% debentures on 1,40,000 will give you 14,000 rupees as the total income from that particular debentures. I hope it is clear. Right? Now let's get back to our column. So point number 2, it is 10% debentures and the value is 14,000 rupees. Again 193 and the rate is 7.5%. What is the amount of TDS? 14,000 into 7.5% would give you 1,050 rupees as the TDS, and the net income would be 12,950 only. So that is the adjustment number 2. So moving on to the adjustment number 3. What is adjustment number 3? It is interest received from debentures issued by Y Limited listed on stock exchange. Interest received from debentures issued. Okay. So third one is not about the investment. It is the income received by you is 32,375. So that is the net income received by you. All right. So adjustment number 3 is a bit tricky. I won't say it as very tricky again. So it is interest received. And the amount of interest received is 32,000. Net interest received will be 32,375. Now, how to compute the gross income? 32,375 you received as an interest. You receive something after deducting TDS. So this 32,375 will be net of TDS. Yes or no? Normally, when you receive dividend, the person who pays the dividend will deduct the TDS. So the amount which is received by you will be the net of TDS, right? So here the net of TDS 32,375 divided by the rate of interest will be under 193 at the rate 7.5%. So divided by 92.5%, it would be 35,000 will be the gross income. Yes or no? 35,000 rupees will be the gross income divided by, how will you get that? That is 100 minus 7.5%. All right. That will give you 35,000 rupees as your total income. Again, the rate is 193. And how much is the rate of TDS? 7.5%. 2625. The net will be 3275. It is just a reverse calculation. That's it. There is no new thing. It is only the reverse. Now, moving forward with adjustment number 4. Dividend declared by a company on 5/6/2020 on shares of B Limited at 100% on 1,000 shares of 10 each, purchased at 60 per share. So dividend declared by the company on 5/4/2020 on shares of B Limited at 100%. So 100% dividend has been declared on 1,000 shares having a face value 10 each. So the face value is at the rate rupees 10 and there are 1,000 number of shares. So the total amount of dividend, total face value of shares is equal to 10,000 and the dividend is at the rate 100%. So the amount of dividend also will be 10,000. Yes or no? So we will come back and write our point number 4, dividend. 10,000 rupees. TDS is required under section 194. Now what is the rate under 194? Normal rate 10%, but due to COVID, from 14th May 2020 to 31st March 2021, the rate has been reduced to 25%. So the reduced rate is now 7.5% because there is a reduction of 25% on the TDS rate. And what is the amount of TDS here? 7.5% means 750 rupees, right? 10,000 into 7.5% means 750 rupees will be the TDS, and the net of TDS would be 9250. 9250 will be the net income, net of TDS. Now, Moving on to the fifth adjustment. If there is any fifth adjustment, yes, there is one more item. 10% dividend on preference shares of rupees 10, each amounting to 2,25,000 paid on 31st March 2021. So there is a 10% dividend on preference shares of 10 each amounting to rupees 225. So the total preference shares you have is 2,25,000. All right. And it is in face value. That's what they're saying. Dividend on preference shares of 10 each amounting to means per share 10 rupees face value and the total is 2,25,000. All right. And now you need to compute the preference dividend is 2,25,000 into 10%. That would give you 22,500 as the dividend. Again, same under section 194, normal rate 10%. Due to COVID, it is 7.5% right now. And what is the amount of dividend is 7.5% is, sorry, the amount of TDS on dividend, it is 1687.5. So the net income, net of TDS 20,000, 812.5. We can round it off to 813. All right. So friends, now we will compute. We have to compute the total income. Total income simply means the gross income. From that, you need to compute the taxes as per normal provision. From that tax, you can deduct the TDS amount. That is the normal procedure. So total income means always it is not the net income, it is the gross income. So total income means 32,000 plus 14,000 plus 35,000 plus 10,000 plus 22,500. It would give you 1,13,500 as the total income. 113,500 is the total income. And I think that is the end of the question. Yes, there is nothing more they have asked. I think that question is also clear for you. It is only an easy question. So friends, moving forward with the next question. Now onwards, it is all about theory, full theory questions. There is no numerical problem. No more numerical problem is there. Now everything is in relation to theory. So the first theory question, discuss the following in relation to TDS provision. All right, so you need to discuss the following TDS provisions. Payment of certain sum by certain individuals or Hindu undivided family, that is section 194M. You need to explain what is section 194M. Simple it is. It is a direct theory question. They're asking you to give a note on 194M. And we have a detailed note on 194M. As you can see it from here, there is a detailed note on 194M. So what is that? Section 194M. Let's see for whom section 194M is applicable. All right. So friends, please listen. If you are an individual or Hindu undivided family, then there is a section called 194C. That means while making payments to contractors. All right. So TDS on contract payment, we will write it as contract payment. Then there's a section called 194J. That is TDS for professional service, royalty, non-compete fee, director's remuneration, etc. etc. All right. Fees for technical service, royalty, director's remuneration, non-compete fee, and finally for professional service. These are the 5 things covered under 194J. So commonly we can write it as professional fee. And there is another section called 194H. That is TDS for commission or brokerage. In these 3 sections, there is a common thing. Individual or a Hindu undivided family will be deductor. They are required to deduct tax only when they will become deductors. Only when they become deductors, they become deductors only if their preceding financial year's total receipts from business is more than 1 crore. Or their gross receipts from profession is more than 50 lakhs. Hope you remember this condition in Income Tax Act. So what is the point? Say simple example, say in 2021, I'm an individual and I'm making a payment under contract, or I'm making a payment, say professional fee, royalty, non-compete fee, or fees to my directors. Normally an individual will not pay any fees to directors or not. All right. So non-compete fee, etc., etc. Or I'm making a payment, commission or a brokerage to any person, then I'm being an individual is supposed to deduct tax only when my preceding financial year, I'm making the payment in 2021 and my preceding financial year would be 1920. So if the preceding financial year, if my total receipts from business is 1 crore or gross receipts from profession is 50 lakh, if in 1920 either my total income from business is 1 crore or professional gross receipts exceeds 150 lakh, then only I am supposed to deduct TDS in 2021 under these three sections. Alright, so 194C, 194J and 194H is applicable only for individuals or HUF where your preceding financial year's total income from business exceeds 1 crore or gross receipts from profession exceeds 50 lakhs. That is the condition. Alright, so if you are an individual and HUF and you are not covered under 194C or 194J or 194H, then you will be covered under 194M. That is what is the first thing. So 194M, who will be the deductors? Deductors will be individual or HUF who are responsible for paying any sum in a financial year to a resident for carrying out any work in relation to a contract or making a payment or a commission or by way of professional fees. Only individuals and HUF who are required to deduct, whom are not required to deduct as per the provisions of 194C, H and J are required to deduct in respect of the above sum payable during the financial year to a resident. So 194M will come into the picture only if that individual or HUF is not covered under 194C, 194H or 194J. Hope it is clear. Now under 194M, what is the rate of tax? Rate of tax commonly normally at 5%. But due to COVID relief, it has been reduced to 3.75%. From 5%, there's a reduction of 25%. And hence the rate will become 3.75%. Now, time of deduction. At what time that individual or HUF is supposed to deduct TDS? Time of deduction, they say, either at the time of credit or making the payment, whichever is earlier. Either the individual or HUF puts a credit in his books of accounts or he makes the payment. Whichever events happens first, at that moment, they are supposed to deduct tax under 194M. And there is a remark. What is the remark? It is a threshold. What is a threshold? No tax is required to be deducted where such sum, as the case may be, aggregate amount of such sum credited or paid to a resident during the financial year does not exceed 50 lakh rupees. That means you are being an individual or HUF. You are making any payment to a contractor or a commission or a brokerage or a professional fee, and the aggregate payment in a financial year you have made does not exceed 50 lakh rupees. That means the aggregate payment you have given is less than or equal to 50 lakh rupees, then 194M is not required to be deducted. So it is just like a threshold. If the aggregate payment made by an individual or HUF whom are not covered under 194C, 194J or 194H is less than or equal to 50 lakh, then you are not covered under 194M as well. I hope that point is also clear because it's that easy. All right. Again, moving forward to the second part in element B. What is the second part in element B? Payment of amount in cash under 194N. You are supposed to explain the provisions under 194N. So let's explain. What is 194N? It is TDS on cash withdrawals under 194N. Who is the deductor? In TDS, you need to know who is the deductor. At what time TDS is required to be deducted. What is the rate? And you need to study the threshold and other exceptions as well. Now, under 194N, let's understand who are supposed to deduct tax under 194N. So, starting with every person being a banking company in which Banking Regulation Act applies, or a cooperative society engaged in the business of banking, or a post office. So deductors are either a banking company or a cooperative bank or a post office is the deductors. All right. When they are supposed to deduct tax, who is responsible for paying in cash any sum or aggregate sum exceeding 1 crore during a previous year to any person from one or more accounts maintained by such recipient person with it. So if you are an individual, if you are a bank, cooperative bank or a post office savings bank, and some person is withdrawing more than 1 crore in cash in a financial year, then the amount exceeding 1 crore, whatever the amount exceeding 1 crore on that excess payment, TDS under 194N is required to be deducted by the bank or cooperative society or post office. You with me? I'll give you one simple example for a better clarity. Say there is a bank, say there is Federal Bank. All right, from the Federal Bank, Mr. JK being an individual is withdrawing 1 crore 30 lakhs. In total, I've made a cash withdrawal in the year 2020-21, and the amount is 1 crore 30 lakhs in total. Different times from the same account I've withdrawn, and the total amount is 1 crore 30 lakh. Then this bank is the deductor. 194N is this bank is required to deduct TDS over and above 1 crore. That means on this 30 lakhs, TDS is required to be deducted by the bank. Even if it is a bank or a cooperative society or a post office savings bank, that person is supposed to deduct tax under 194N. I hope that much is clear. Now friends, what is the rate? Rate is at 2%. There is no COVID relief. It is 2% normal, and in the COVID times also it is 2%. And when TDS is required to be deducted, it is required to be deducted when the payment is made by the person. At the time of payment, TDS is required to be deducted. Now friends, what is the next one? Deduction shall be made on withdrawals exceeding 1 crore only. If the withdrawal is less than 1 crore, then TDS is not required to be deducted. Only on the excess value, you are supposed to deduct TDS. All right. Now, liability to deduct tax at source under 194N shall not be applicable to any person. So there are certain exceptions. All right. So if the amount is withdrawn by these category of persons, then 194N is not applicable. Say for example, if the amount is withdrawn by government from a bank or a cooperative bank or a post office savings bank, TDS not required. Again, if the amount is withdrawn by any other banking company or a cooperative society, then also TDS is not required to be deducted. And again, if the amount is withdrawn by any business correspondent of a banking company or a cooperative society engaged in the carrying of banking in accordance with RBI guidelines. Say there are a category of persons called business correspondents. Say in a rural area, there won't be any proper branch of a bank, but a person will represent a bank. That person will carry out the standard banking transaction on the customers in the rural area. If that person is withdrawing a bulk amount from any nearest branch, and he is distributing that amount to different customers, at the time of withdrawal again, that bank is not required to deduct any TDS. That is why if the amount is withdrawn by a business correspondent of a bank, in that case also TDS is not required to be deducted. Moving forward, any white label ATM operator of a banking company or a cooperative society. What do you mean by white label ATM operator? It means your cash replenishing agency. Say for example, I'm a person and it's my duty to replenish. That means to maintain a balance in the ATM. Say for example, different customers will come and withdraw from this ATM. It is my responsibility to withdraw from bank and to load cash in this ATM. So for loading cash, I require cash, right? If I'm withdrawing cash in excess of 1 crore for loading it in ATM, that case also TDS under 194N is not required to be deducted. Again, for commission agents also, commission agents of agricultural produce marketing committee, if they are withdrawing, say there is an in-between commission agents, just like Mandi houses, there are in-between commission agents for this agricultural marketing society, and that person is withdrawing a lump sum amount from bank for this marketing purpose, then again TDS is not required to be deducted under 194M. And finally, not 194N, not M, it is N. And finally, full-fledged money exchanger. Say you are a full-fledged money exchanger, foreign money or a foreign currency exchanger. For your business, you have withdrawn cash over and above 1 crore. That case also, TDS under 194N is not required to be deducted. Now friends, with effect from 1st July 2020, there is an amendment. There is an amendment as well. And what is that amendment? If the recipient has not furnished returns of income for all immediately preceding 3 previous years, the sum shall mean the amount or agreed the amount as the case may be in excess of 20 lakh during the previous year, and the tax shall be deducted at a rate of 2% on the sum where the amount or agreed the amount as the case may be being paid in cash is more than 20 lakhs but less than or equal to 1 crore, and 5% of the sum where the amount or agreed the amount as the case may be being paid in cash is more than 1 crore. However, government is empowered to specify this with the consultation of RBI by notification, the recipient in whose case this provision shall not apply or at a reduced rate subject to the satisfactions of conditions specified in such notification. My God, what is this? Simple friends, I'll tell you. From 1st July 21 onwards, there is a new amendment. What is that amendment? Say, in simple example, I'll tell you, JK is withdrawing an amount. Normally, 194N is applicable only if JK is withdrawing more than 1 crore from bank or a cooperative society or post office savings bank. Yes or no? But from uh, July 7th, 2021 onwards, first thing you have to check is whether JK is withdrawing, say JK is withdrawing any sum in the year 2020-21 after 1st July 2021. Then the bank need to check whether JK has filed his returns in the preceding years. Preceding years means say 1920, 1819 or 1718. Say JK hasn't filed his returns for all of these 3 years. JK hasn't filed his return for say 1919, 1920, 1819 and 1718. All these 3 years there is no return filed by JK under income tax. JK haven't filed any returns. Then what happens? Then this bank is required to deduct TDS when JK withdraws an amount over and above 20 lakhs. Then the threshold instead of 1 crore it will be 20 lakhs. When JK withdraws an amount which is more than 20 lakhs, this bank or cooperative society or post office savings bank is required to deduct TDS at what rate? Over and above 20 lakhs up to 1 crore, the TDS rate should be 2%. And if there is a withdrawal over and above 1 crore, above 1 crore, the TDS rate on and above 1 crore should be 5%. Say simple example, JK is withdrawing 1 crore 30 lakh in the year 2020-21. Say, to be very precise, 1st February 2021, I have withdrawn 1 crore 30 lakh from my bank account, from my federal bank account. Then what will happen? And JK haven't filed any return for 1920, 1819 and 1718 as well. Then what will happen? You tell me, friends. It is very simple. Over and above 20 lakhs TDS under 194N will get attracted. So on over and above 20 lakhs, 20 to 1 crore, there will be 80 lakh rupees. From 20 lakhs to 1 crore, 80 lakh rupees is there. TDS on 2%. Over and above 1 crore, how much income is there? 30 lakhs is there. On that 30 lakhs, TDS at 5%. Both are required to be deducted by the federal bank at the time of withdrawal. So the thing is, from 1st July 2021 onwards, while withdrawing the sum, you need to check whether the withdrawer has filed returns in any of the 3 preceding previous year relevant to the what year of withdrawal. Preceding previous years, if any of those years, if he has filed a return, then 194 a normal provision. Otherwise, from 20 lakh onwards, TDS is required to be deducted. All right. Say JK has filed return in 1718, but no returns in 1819 and 1920. Then also 194 and normal provision. Over and above 1 crore, TDS is required to be deducted. Only over and above 1 crore, TDS is required to be deducted. Not that point in your mind. I hope that is clear for you. So friends, without wasting time, let's surf forward. Now the next is short note. You need to write any 3 from below. We will discuss everything. First of all, number 1, interchangeability of PAN and Aadhaar under 139A5E. That's what we are gonna learn. It's a very short note. You can write it in 3 or 4 sentences. So starting with interchangeability of PAN and Aadhaar under 139A5E, it says every person who is required to furnish or intimate or quote his PAN number and who has not been allotted PAN but possesses Aadhaar number may furnish or intimate or quote his Aadhaar number in lieu of PAN, and such person shall be allotted a PAN which such manner may be prescribed. It is very simple. Say you need to quote your PAN number. Under income tax, there are certain situations and there are certain transactions on which a person is mandatorily required to quote his PAN. So if you comes under that category and you don't have a PAN number, but you have applied for a PAN number, then instead of PAN, you can quote your Aadhaar number and comply. That's it. It is just like interchangeability of PAN and Aadhaar. Instead of PAN number, you can quote your Aadhaar number and comply with the provisions. That's it. Now, situation 2 has been allotted a PAN who has initiated intimated his Aadhaar number in accordance with provisions of 139AA may furnish or intimate or quote his Aadhaar number in lieu of PAN. Okay, you have PAN number, but you can quote your Aadhaar number and you can comply with the provision. That's it. That is interchangeability of PAN and Aadhaar. Hope it is clear. Very simple provision. Instead of PAN number, you can quote your Aadhaar number. That's it. All right. So moving on to the second short note, provision regarding furnishing of return in case of high volume transaction. So this is covered under section 139 subsection 1. All right. So let's see. Under 139 subsection 1, furnishing of return in case of high volume transaction. A person other than a firm or a company who is not required to furnish a return as per the provisions and who during the previous year. So let's understand this. So friends, under 139 subsection 1, there is a clause. If you are an individual or a Hindu undivided family or an HUF, or a AOP or a BOI or an AJP, then you need to file your return only if your total income exceeds basic exemption limit. Hope you remember that point. But the Act says certain other situations also. That means, what all are the other situations? Let's understand. If you have deposit an amount aggregate 1 crore in one or more current account maintained with a banking company or a cooperative bank, say your total income is less than basic exemption limit, but in that year you have deposited around 1 crore or more in current account maintained by you, then mandatorily you need to file your return. That's it. It does not depends upon your total income, but based on your high volume transactions. And what is that? Your total income is less than basic exemption limit, but you have deposited around more than 1 crore in any of the current account maintained in a bank or a cooperative society who's in banking business, then mandatorily you need to file your return. That's it. They're not saying that you need to pay any taxes. They're only saying file your return and explain. And in certain situation, say you are an individual or HUF, but you haven't, you are not required to file your return. But you have incurred an expenditure in aggregate exceeding 2 lakh for foreign travel for yourself or your dependent person or other related person. Say for example, your total income is less than basic exemption limit, but you have expended more than 2 lakh rupees for foreign travel, then you need to file your return. That's it. They're not saying that you need to pay taxes. You need to file return and explain why your total income is less than 2 and your total income is less than 2.5. But how can you expend around 2 lakh for your foreign travel? Just explain by filing a return. That's it. And situation number 3, if you are an individual or HUF or AOP or BOI or AJP and you are not required to file your return because your total income is less than basic exemption limit, but you have expended around more than 1 lakh rupees for electricity consumption. Say your total income is less than 2 lakh 50, but you have expended for electricity over and above 1 lakh, then you need to file a return and explain why. That's it. All right. And there is one more thing. A person who fulfills such other conditions as may notified by the notified. That's it. So what it says, apart from these 3 situations, apart from depositing 1 crore or more in current account, or apart from expending 2 lakh or more for foreign travel, and apart from expending 1 lakh more than 1 lakh for electricity charges, if you have done some other transaction which is notified, which is yet to notify, some other transactions which is notified, in that situation also you need to file your return. So no such things notified yet. It is yet to notify. So that is also there. That is the end of that particular short note. It is an easy short note only. Again, without wasting time, let's move forward. So situation C, scope and disclosure requirement of ICDS 3. ICDS 3 you need to explain. That's it. We will have a very summarized discussion on ICDS 3. ICDS 3 is for construction contracts. First of all, what is ICDS? It is Income Computation Disclosure Standards. All right. So you need to explain ICDS 3 and let's understand what is ICDS 3. So this ICDS is required to be applied in determination of income for construction contract of contractors. So it is just like your accounting standard. While computing total income for the purpose of income tax, you need to follow ICDS, Income Computation Disclosure Standard. Out of that Income Computation Disclosure Standard, 3 is in relation to what? Determination of income of construction contracts. Say you are a contractor and you are carrying out construction works. How to determine or how to disclose your income? That is what ICDS 3 is all about. Now, it recognizes percentage of completion method for recognizing contract revenue and contract cost associated with a construction contract. So in the accounting, just like in the accounting standard, you in income tax also, percentage of completion method and its related cost you have to consider. Say 30% of construction is over, then that much income you can recognize, that much expense you can claim. The net will be your profit from that particular construction activity. That's what ICDS 3 states. Moving forward, contract revenue shall be recognized when there is a reasonable certainty of ultimate collection. What do you mean by reasonable certainty? If you know that you are in receipt of an income, at that point, recognize the income. That's it. Reasonable certainty means you are quite sure. That doesn't mean you are 100% sure. You know you are going to earn some income. At that moment, you are supposed to recognize that particular income. On reasonable certainty, you are supposed to recognize the income. Now, contract revenue shall comprise of initial amount of revenue agreed in the contract, including retentions, and variations in contract works, claims, and incentive payments to the extent it is probable that they will result in revenue and they are capable of being reliably measured. It is very simple, friends. Say, for example, in a contract, there will be retentions. What is retentions? Say, even if 100% of your contract is over, 100% of work is over, say, for example, certain persons only will release 90% of the payment. They will retain 10%. Say, for example, JK is the contractor and he has done a work for Mr. A. Mr. A is my client. 100% of the work is over. Percentage of completion is 100%. But Mr. A released only 90% of the payment. Mr. A will release the remaining 10 only after an inspection. Say only after 1 month's usage. This 10% is called retention. So for recognizing, you need to treat both this initial amount and the retentions. You need to consider it as your income. That's what they are saying. All right. So contract revenue shall comprise of the initial amount of revenue agreed in the contract, including retentions, and variations in contract claims and incentive payments to the extent that is probable that they will result in revenue and they are capable of being reliably measured. What do you mean by that? Say, for example, friends, Mr. A, all right, Mr. A and Mr. JK has entered into a contract and JK will carry out contract work. Say the contract value is for 10 lakhs. We have agreed the contract value for 10 lakhs, but we have put an escalation clause. Escalation clause means what? If there is an increase in, Mr. A will pay me only 10 lakh. I need to complete his contract. I will put a clause. If there is a price increase for cement or iron or for other materials or labor hike, then you should give me an additional 10%. This is said to be escalation clause. So this escalation clause will be operative only when there is a price hike or depends upon the condition put in the escalation clause. All right. Say there is a price hike in the cement increase. Sorry, there is a price hike in cement. All right. Or there is a increase in price for the cement price. Then what will happen? At that moment itself, I know my escalation clause is gonna active. Right. At that time itself, my escalation clause will get activated. At that moment, what I'm supposed to do? I need to recognize that 10%, additional 10%. That's what they're saying. Are you getting my point or not? What it says? Variations in contract claims and incentive payments also recognized as income to the extent that is probable that they will result in revenue and they are capable of being realized. That simply means whenever there is an increase in the cement price, I know I'm gonna get an additional 10% on the value of the contract, right? At that moment itself, I can recognize that income as per ICDS 3 construction contracts. I hope you are with. Moving forward, the contract cost shall be reduced by the incidental income, if any, not being in nature of interest, dividend, and capital gains that is not included in the contract revenue. So the contract cost, say for example, in the contract cost, say, simple example I'll give you. Say for example, I've purchased some bricks, some foreign bricks for 10 lakhs. I've purchased from foreign bricks for 1 lakh. I'll put it as 1 lakh. And there's a, it's a foreign bricks. I've purchased it from USA. It's only an example, okay? And I've earned something. Ultimately, I'm supposed to pay only 90,000 due to foreign exchange fluctuation. So at the time of purchase, I'm supposed to pay around 1 lakh. But the time of payment, I'm supposed to pay around 90,000 only. There was a foreign exchange gain of 10,000. So this 10,000 have to be reduced from the cost because purchasing bricks is actually cost for me, right? So if there is any incidental incomes that have to be reduced from the cost, that's what they are saying. The contract cost shall be reduced by any incidental income, if any, not being nature of, say, in nature of interest, dividend, capital gain, etc., that have to be treated as separate income itself. If there is any other incidental income in relation to contract, just like I've said, foreign exchange gains or something, you can reduce it from your cost. Common sense. All right. Again, Cost that cannot be attributed to any contract activity or cannot be allocated to a contract shall be excluded from the cost of construction contract. Say if a particular cost has no direct nexus with the, what do you say, with your construction contract, you are not supposed to consider that as your cost. And then where contract revenue already recognized as income is subsequently written off in the books of accounts as uncollectible, then the same shall be recognized as an expense and not as an adjustment of contract revenue. Say for example, there is a very small price hike. This is a simple example. In the escalation clause, I hope you remember that point in relation to escalation clause. What was the escalation clause? If there is an increase in cement price, I'll get an additional 10%. All right. So there is a small slight increase in the price of cement. I have recognized that additional 10% on 10 lakh, say 1 lakh as my additional income. I have treated 1 lakh as my additional income because there was a increase in the price of cement. But my client said, Mr. JK, there is only a slight increase in the cement or cement price. I'm not going to give you this additional 10% because the increase in price is negligible. All right. I've already recognized 11 lakh as my income. 10 lakh is the original amount. 10% increase was the escalation clause income. So if that's so, then in the next year, what I can do, I can treat 1 lakh as an expense. That's it. So if an amount is not being capable of realized, if I'm sure that I will not get that particular amount, then don't adjust it in the income. You can treat it as an expense. That's what they're saying. Where the contract revenue already recognized as income is subsequently written off in the books of accounts as uncollectible, then the same shall be recognized as an expense and not as an adjustment of amount of contract revenue. Don't adjust your contract revenue, treat it as your expense. Simple, isn't it? Then moving forward, contract cost and other contract costs that relate to future activity on contract are recognized as an asset. So for example, contract costs that related to future activity. Say you have incurred some additional cost for a future, that should be recognized as asset. That's what they're saying. Such costs represent an amount of due from the customer and are classified as a contract work in progress. You can treat it as a work in progress or something else, but you need to consider it as an asset. You are only supposed to consider while recognizing cost, that percentage of completion mandate should be there. If you're incurring some additional cost, then that should be treated as a work in progress, just like an asset. All right. Finally, during early stages of a contract, where the outcome of contract cannot be estimated reliably, then the contract revenue is recognized only to the extent of cost incurred. And such early stage of contract shall not extend beyond 25% of stage of completion. What do you mean by this? Say I have entered into a contract. This is the first year of contract. Say my percentage of completion is only 5% and I haven't received any income. My percentage of completion is only 5%. So what I can do, how much cost I have incurred for completing this 5%, that much income I can recognize. That simply means I don't have to recognize any profit. Say for completing this 5%, I have incurred 10,000 rupees as cost. 10,000 rupees as cost, then that 10,000 I can show it as my income as well. That's it. So in the initial stages of a contract, if you are not able to measure your completion reliably, during the early stages of contract where the outcome of contract cannot be estimated reliably, contract revenue is recognized only to the extent of cost incurred, and the early stage of contract shall not extend beyond 25%. Say your percentage of completion is more than 25%, don't call it as initial period of contract. All right. If your percentage of completion is more than 25, you need to strictly follow the percentage of completion, related cost, etc., etc. Till that you can you need not follow that percentage of completion method strictly. That's what they are saying. I hope that point is also clear. So this is more than enough. I think I have covered every important point under ICDS 3. This much is actually not enough while writing a short note, but still it is only for our educational purpose. I have explained this much. In examination, you need to write only 3 or 4 points. That is more than enough. I hope you are with me. Okay, friends. Now moving on to the next question. That is not question. The next short note, that is short note number D. Issue of notice under 142 subsection 1. Write a short note on 142 subsection 1. Normally we will call it as multi-purpose notice. It is in relation to your assessment procedure chapter, your AP chapter. All right. So what is this, friends? For making assessment, the assessing officer can make an inquiry, and provision relating to inquiry before assessment is given as under. Say, for example, the assessing officer in certain circumstance can serve a notice requiring these three things. So these are the purposes. Multiple purposes are there. So normally we call it as multi-purpose notice because it has multiple purposes. As simple as that. Now let's understand which all are the purposes, which all are the multiple purposes of 142 subsection 1 notice. So the first purpose, if an assessee haven't filed his return, then the assessing officer can serve a notice to the income earner or to the person who earned income, stating that Mr. Say for example, Mr. A, I know that you have income and you haven't filed any return. Come and file your return. This is the first purpose. So to furnish a return of income, a return of his income or the income of any other person in respect of which he is assessable under the Act. What do you mean by income of any other person in which he is assessable under the Act? Say, for example, a mentally incapacitated person who has a lot of passive income and there is a guardian. That guardian takes care of this mentally incapacitated person. So this guardian is supposed to file his return on behalf of this incapacitated person. So if the guardian make a failure to file his return, then the department will send that guardian a notice and will definitely require him to file a return on behalf of that incapacitated person. So that's what they are saying. Either for returns for his income or income of any other person in respect of which he is assessable under the Act. In case a person has not filed return within the due date or before end of relevant AY. So for filing return, 139 subsection 1 states about the due date. So if you have made a default, then definitely they will. It is not mandatory. Okay, department every time will not serve you this particular notice stating file your return and all. It is according to their discretion. If the department wants you to file a return, then they will serve. That's it. Depends upon the circumstance. Now, second purpose of that notice is to produce or cause to produce books of accounts or documents. Say, for example, you have filed a return. That return has been picked for assessment. That means cross-examination. All right. Then the department require your books of accounts, right? So for getting your books of accounts, the department will serve you notice. What is that notice? Mr. A, we have selected your return for assessment for the purpose of assessment. Come with your books of accounts for these years. That is the second purpose of this multi-purpose notice. Now there is one more note. AO shall not require production of any accounts relating to a period more than 3 years prior to the previous year. Simply means what? Say you have filed a return in 1920 and this has been selected for assessment, a regular assessment. For completing regular assessment, department definitely can ask your books of accounts for 1920 by serving a 142 subsection 1 notice. Along with the 1920, department can ask your books of accounts of 1819, 1718, 1617, not later than that. So apart from relevant PY, which is selected for assessment, the department can definitely serve a notice for requiring you to furnish books of accounts for the preceding 3 previous years. For 1819, 17, 18 and 16, 17, definitely they can. So that's what they are saying. AO shall not require production of any books of accounts relating to period more than 3 years prior to the PY. Prior to the relevant PY, don't ask books of accounts more than 3. Maximum you can ask is 3 preceding relevant PY. All right. And to the final purposes, to furnish in writing information on such points and other matter, including a statement of all assets and liabilities of the assessee, whether included in the accounts or not, as the AO may require. So the final purpose of this particular multi-purpose notice is department may serve a multi-purpose notice. Say, for example, there is some information in your books of accounts. Then department, if they require some additional information or clarification on that particular point, definitely they can send a multi-purpose notice under 142 subsection 1 and they can ask you to submit more further information. Say, for example, your bank account details is there. Department definitely can serve a 142 subsection 1 stating that bring us the bank statement. That is an additional information over and above your books of accounts. So like that, department may ask items in the books or items which are not in the books. What is that? Say for example, you have furnished your return, all right, and you have submitted books of accounts, but department knows that you have some other assets which is not included in the books. In that case, department may ask a detailed statement stating that we know you have these kinds of assets, it is not included in your accounts, give us the additional information. All right, they also can ask like that. But there is a thing, the previous approval of JC means what? Joint Commissioner. The previous approval of Joint Commissioner to be obtained for requiring assessee to furnish statement of all assets and liabilities not included in the books of accounts. If a particular state assets or liability information is not included in the books of accounts, but the department wants to get an additional information in relation to that asset which is not included in the books, then assessing officer must obtain prior approval of Joint Commissioner for asking that particular detail. Simple example I'll give you. Say for example, I have some foreign asset. The information in relation to this asset is not included in my books of accounts, but department knows, somehow they came to know that I have some foreign asset. Then department definitely can serve a notice under 142 subsection 1 stating that Mr. JK, we know that you have some foreign asset, bring that information. But before asking this, assessing officer should obtain an approval from Joint Commissioner, and that's what they are saying. I think by this we came to an end to our question paper discussion. So friends, if you I hope you are able to follow this session. So please share this video with your friends and colleagues. So take care, all the very best for your examination, and bye-bye.